You're live.
All right, guys. April 20th, 2020. We have a new trade alert. U.S. oil is getting crushed. Brent oil, not as much, but U.S. oil is really in trouble. So we're going to go ahead and take advantage of that today. There is plenty of blood on the streets. There could be further down move, but we'll explain why we're jumping in on it today. So how far down will oil go? All the way to China, the Hedgehog cartoon jokes. What's happening in the big picture? We still have a oil war. Every tanker around the planet's getting filled to the brim. And this is all because the economy, the global economy is getting crushed as governments are faced with keeping the economy alive versus trying to protect the health of their society. And this is going to be a problem that's not going away anytime soon. Jump to our trade alert to go over it in detail. So here's the trade alert document that you have in your email account. So there's two popular prices for oil. This is WTI, not Brent. And you can see it just going to historic low this morning. And so if we do scroll a little bit lower to this chart, here's the actual ETF we're purchasing, USO. I just found it comical that the Robinhood users are getting absolutely murdered in this position all year as they continue to buy it. And we sat back patiently and are able to jump in at a great discount. So compared to January, this is trading at a 70% discount. If you go back to 2015, we're trading at a 90% discount. We're not just buying this naked though. We're purchasing it with the in the money put. This will allow us to build the position today, start the stopwatch for a year hold so that we can potentially start peeling off profits at some point after we've held this position for a year. So I do try to strategize our positions to hold for a year, get the lower tax bracket, and think way ahead of the curve. So is there potentially more downside risk for USO? Yes. And that's why we have that juicy $4 put option. So I do think we could potentially see ourselves selling that put for a large profit as we hold this position. Okay, so let's go back up to the top and work our way through the trade alert. Okay, so the new trade alert is a pro member position, and I've been giving out our pro member positions for everyone until we really see the stock market correction get underway. So just for those of you who are only following the basic program, this is not a position you need to put on. However, if you are considering upgrading from our basic portfolio to the pro, then I would take this into account. For every $75,000 in the model portfolio, I'm purchasing 2,000 shares of the USO ETF and protecting that position with 20 in the money $4 strike January 15, 2021 USO puts. So this is our married put strategy. When you combine the cost of the ETF plus the cost of the put option, this is approximately a 13% total allocation. However, with the in the money put between now and January 15th of 2021, we can lose no more than approximately 2.5% of our total portfolio. So if this goes anywhere near the levels it had earlier this year, we're looking at a 200% return. And obviously, if this goes back to 2015 levels, then we're making upwards of a 10-to-1 return. Now, in the big picture, I do think the oil market's going to be in trouble for a considerable amount of time. And we very well could be a little early on this position. So once again, that's why we're buying it with the put option. And the plan is if the market does go considerably lower, and USO is allowed to go lower, keep in mind, I do predict the government's going to protect these companies as a national security to remain energy independent. So it's a big if that we do see USO go much lower than it is. The general stock market, I believe, has a 50% plus correction coming our way. So with that in mind, the strategy is, again, to pick up the asset now, buy the put option for downside protection, which is in the money. And then here's really our two outcomes. So if USO does go lower into the summer months, and this could be correlated to the S&P 500 falling lower, then we're going to remain long our shares and sell the put option for a profit. So this will offset our downside risk to buying USO currently. If the US government comes in there and props up the United States oil companies, or if the market just doesn't crash because the Fed continues to print like a madman, then we just need to work off the $1 cost on our put option by January 15, 2021 to derive profit. And in terms of targets, I would anticipate no less than $8 a share as a target for this position. So again, this ETF is trading at a 70% discount from January of 2020 and a 90% discount from 2015. And we know that the United States will bail out the US oil miners. Question is when and how. And so that's why we still want to have our downside protection, as there's clearly risks in the oil market. But once again, the US must remain energy independent. And this is a sector they cannot afford to allow to go bankruptcy. So today was a big jump down on GDX, and we're pouncing on it, or rather on USO, and we're pouncing on it. And so now in our commodities tab, we have really overweight. So usually we have around 10 to 12% of our total portfolio playing the commodities market, but now you have a double whammy. You have the GDX position, gold miners, and then you also have USO. And so again, our goal here is to get the clock to the 1 year hold as soon as possible so that we will have the flexibility starting in May of 2021 to start selling these assets for a profit and pick up the new value play. And quite likely, if it does look like we are on the right track to getting a vaccine in place, proper therapies, the real big play next year will be potentially looking at getting copper at a huge discount, assuming that we can get our global economy back on track. So that's really the methodology and thinking, the value play, the opportunity, the blood on the street. It's all out there. So we've been waiting patiently to buy some sort of long US equity position. And despite there clearly being more trouble ahead for oil, I do really, really like this risk to reward. So on the risk side, we can lose up to 2.5%. And that's based on USO just crashing indefinitely and us having to cash out our put. But once you start to realize that the government has to protect this asset, the lower it goes is really no problem for us, because again, we have that $4 strike put, and we will sell this probably correlated to when we sell other put options in our portfolio, and then just remain long the ETF. So if the bottom's in for USO, we need to work off that dollar we paid for our downside puts, and we've got a target upwards of 8. So this is a great position. We've been very patient to put it on. And so bravo to those of you who've been following us, who's had a lot of cash on the sideline, dying to spend it. We're slowly but surely getting this full portfolio allocated. Okay, so I do want to keep the chat box open. I'm not going to do any mics till I do get through quite a bit of content, but if you do have questions, post that through. Ernest. Is my audio still coming through? I just heard a interesting.
It sounds good to me.
Okay, good.
Yeah, it sounds good, Jay.
Okay. I have some audio message popping up. Ram asked a question if we're doing the puts, you're gonna have to rephrase that question, Ram, into a single question if you can. It seems.
Hey, Jason, are you still there?
Hey, Jason, you still there, bud? So Ram's question, he said, he basically asked, aren't they way out of the money? And yeah, Ram, absolutely.
Okay, so
yeah.
Okay, great. Yeah, I understand this question. Okay, I'll get to that. 1 second, just getting the power on my headset fixed here. Okay, good. Ernest says, what do you think about selling puts instead of, so that's a different risk profile, Ernest. And I wouldn't recommend that because if it does crash 50% from here, you could potentially lose quite a bit on that. So it's a different trading strategy than we're currently putting on. So if we own the asset and all of a sudden US oil jumps 100%, then we pay off that put very quickly and get the real benefit of this extremely sold off asset. And then Ram says, do you plan on increasing the SPY put positions? All right, guys, I think we're fixed now. Okay, back on track here. Yes, I am looking at optimizing our put option position, Ram, but the current positions are good to go still. So no change on those currently. Okay.
Hey, Jason, you still there, bud? Okay, cool.
Okay, we're good. Okay, good. Just checking. So,
yeah.
All right, great. So let's continue. So that's our trade alert today is to build the USO position with the put. So our total risk for the next 9 months is, or rather for the next, this gives us 9 months of protection to buy and hold USO. If it does crash lower, we'll be selling that put and remaining long USO. If it just depreciates, we want it to go up by over $1 to make a profit. So it's a pretty simple trade. And I do have a target of above 8 to start selling this. So that's the new trade alert. Let's continue going through the trade alert document. The rest of our portfolio is designed to profit from a slowed global economy in 2020 and will deliver great profits if there's a stock market crash and or US Treasury bond rally. Meanwhile, we eye the prize US equity ETFs to purchase at far lower prices next. So let's continue on. If you're in the basic membership trading Monday, Wednesday, Friday, we only play US equity positions, and that does remove any commodities plays. So we're looking at the current strategy for basic members. It's quite simple. You're going to pick up this set of 5 puts, which are really our epic crash puts that will only drive profits if we do get a significant sell-off and break through our recent lows. And I do highly anticipate that will occur. What's the key cause? Well, besides record unemployment, besides the economy being shut down, really the key here is that the Fed has been slowly but surely tapering off quantitative easing. And I'll go over what their strategy is and game plan and why every time they've ever cut rates to 0, and had to ramp up debt to pay off losses in the economy, we've ended up with a stock market crash. And I do anticipate this will not be any different than every other time in history. So we'll go over that in great detail. This is your current set of put options to purchase. I'll be likely adding a 250 SPY put with a July strike with a substantial position either this Friday or next Friday. I do want to see the Fed continue to taper down QE, which is really the only thing keeping the stock market open right now in terms of going up in value. And they have been. So they've slowly but surely dropped it from 65 billion a day in quantitative easing to 50 to 35, and now this week it's only 25 billion a day, which is still a lot of money, but it's been cut by 66% already just in the last 3 weeks, and I do anticipate them going far lower. And once we see what their scheme is, the bankers' scheme, which I'll clearly lay out for everyone, you'll understand why this makes bankers rich and why they can't wait for the stock crash so they can pick up stocks as well. No, opening up the economy gradually is going to be a disaster. We'll take a look at that. And yeah, so we'll take a good look at that. But yeah, I'm expecting a massive crash into the summer, not a rally. And also the Fed's making sure that happens with cutting out quantitative easing. So again, the put options are a position we want to buy and hold, and also has a double whammy. We're going to profit from the puts if the S&P 500 does go down, but it's also going to give us the hedge to rotate into the ETFs that'll benefit from all the government stimulus and money printing going on, which is healthcare, biotech, medical devices, e-commerce, and then we want to get in on Boeing at these ultra low prices, which is part of the ITA. And also we're anticipating frictions between US and China gradually spiraling out of control, potentially into the election and certainly after the election. So we can take more detailed look at that. Here's the ETFs and why we're not buying them currently. You can see Amazon's at all-time highs, driving that yellow line higher, ONLN, but it's still correlated to the entire stock market. The new economy, all you got to do to get a feel for that is go to your local Home Depot or Lowe's and sit there and wait for an hour to get in with the big lines, the social distancing. So the new economy is going to be totally different than what we're used to in 2019, and will be that way until there's a vaccine, which is really a long shot. So certainly we can predict that companies' profits are going to be much lower in 2020 relative to 2019, and that the government's debt growth will have accelerated or ballooned. And when those two things happen, it always results in a stock market crash and a huge bond market rally. And again, I'll go through the mechanism of why this makes big banks like Jpmorgan absolutely rich and how they're all in on this to pick up assets half off or more, which again, they've done in 2008, every crisis has played out exactly the same. Now, the next part of our trade alert is the pro membership positions. If you're just doing the Monday, Wednesday, Friday program, really the only thing I have for you right now is to buy those puts and sit back until this summer, where I anticipate us being able to buy the great US companies that will be trading at a discount and who really stand to have increases in profits and revenues relative to their competitive peers, which again, I believe will be healthcare, Johnson & Johnson, biotech. You got a lot of great biotech companies that really stand to make potentially trillions of dollars from this current crisis. Medical devices obviously have a huge demand currently. And now that's going to be such a pain in the ass to go shopping because you have to stay 6 feet away from everyone and wear a mask. E-commerce is really set to outperform their peers. Throw in a little military position because the military continues to grow its budget at rapid pace. We can anticipate that sector will be just fine and dandy, especially trading at these great discounts. You can see in the purple line, this is ITA, really the best value play currently. So if you're in the basic program or only doing US equities, excluding commodity related trades, so you really have just one position to put on today, your puts, and then sit back and wait for the opportunity to buy stocks half off is really what I'm anticipating, if not potentially a greater discount than that. If you're in the pro membership, we have more things for you to get to work on immediately. And again, we are providing this on the Monday, Wednesday, Friday trades until this crash is well underway. So if we thought of your trading, if we were to look at our trading plan as a analogy, as a house, then the put options act as your foundation. The cash currently in your account are the walls, which again will be rotating into these ETFs. And then in the pro membership, we complete your house. The bond market's your roof. So the TLT ETF is our best play, most likely the best performing, lowest volatility asset you can buy for the foreseeable future. And again, is where we have most of our cash parked for pro members. So that does represent just about 44% allocation at our current levels. Gold miners, very similar mindset to GDX, USO. They're both highly correlated to stocks, and we're really front running what we anticipate in the future. So with gold miners, we're actually hoping for inflationary pressures into 2021 after all this massive debt works its way from the printing press to the US government and then is funneled into corporations, then down to employees, and slowly but surely creates inflationary pressure. So we love GDX, but there could very well be downside risks ahead. That's why we have the put option protecting us and allows us to set the clock to get that position started. And again, we've been in this position for really most of 2019 and into 2020 as well. USOs are new position, smaller relative risk. And again, I am anticipating the US government bailing out this group of companies as it's critical for national security to remain energy independent. So could be some downside risks on USO, but that's why we have our put. At the end of the day, our goal is to sell the puts for a profit, remain long our equity positions, and then have the flexibility after a year hold time to be able to rotate those into new bargain prices. So with the smaller percentage of our portfolio, you can see we've been picking up riskier positions that have greater upside and then using the married put strategy to really benefit from a buy and hold strategy on these assets. So if you do want to follow the full system, you can build the rest of your house. You can buy the TLT ETF. We have 200 shares per $75,000. That's a 44% allocation. We now have 400 shares of GDX per $75,000. And we just today added 2,000 shares of USO. That's the United States Oil Company. This is, again, the same set of put options that we're currently holding. And this will be most likely letting go of these three this summer while we remain long these two. And I'll explain why we may see a market crash that does really trick a lot of people in 2020 and could extend into 2021. So I'll definitely look at the reasoning behind that in a moment. The TLT options, we have 4. One is a put option, which we're rolling over every week. It's an out of the money put, not an in the money put, so much different than our GDX and USO position. So while we're doing the in the money put options on GDX and USO, expecting downside risks in the near future, we're doing the opposite on the TLT. We're buying an out of the money put with a short duration and rolling that over every Thursday with a Friday expiration. So the idea is to trail underneath the TLT, a cheap put, in case something goes wrong in the bond market. Now, I think that would be highly unlikely, but despite that, our entire portfolio is always protected with put options. So this does help us ensure that we have low volatility, even if everything goes wrong in a quick moment. Now, the long call options are simply giving us extra leverage on our favorite play, which is again expecting a bond market rally. And so these are all buy and hold positions you can put on today that do help you get extra leverage betting on stock markets having a slowed period of time, which drives bond prices higher. This is our current GDX put option protecting us through 821, the 28 strike put. And again, once you combine the put option with GDX, your total risk in that position is minimal. And the same is true for USO. So we can risk no more than about 1.5% of our total portfolio between now and 821 on GDX. And we can lose no more than 2.5% of our total portfolio between now and January 21st, 2021 on our USO position. Now, on the other hand, if these assets double or triple, like they very likely could, we just lose the cost of our puts and the underlying asset delivers our profit. So it's a beautiful setup when you want to be long a position and you're buying into a crash. Now, because of the magnitude of the crash in USO and the potential huge upswing in price, that's why we're not selling the puts, as I do anticipate us doing early on when we rotate into this group of ETFs up here. Okay, other trade alerts we currently have open. We have a EEM put that's doing very well, and this is not a buy today, although we do need to look at selling this in the near future. It's in the money, so we're not in a huge rush, but I do anticipate us selling this before the expiration date on the next big leg down, which hopefully we can catch in the next 1 to 3 weeks as a realistic time period based on the Fed really putting an end to quantitative easing, signaling that bond investors will have to buy and hold to realize a profit, which will be very bad for stocks. Now, the new position that you can put on that does give you more time premium is FXI put options. The 31 strike, November 20th. No coincidence, this is correlated to the election. I anticipate a lot of geopolitical tensions between US and China in the next several months, really causing FXI to drop. We're also seeing lots of problems develop in Hong Kong, which further pushes this trade in our direction. And for those of you in our boot camp in the Hong Kong trade, that's looking better by the minute. So this trade, if the US was to outlaw capital flows to Chinese companies because they don't do US-based auditing because the Communist Party says it's state secret, then I could see this going to a value of 0 and we get a 30-to-1 return. If they don't go to that extent and we just get a significant sell-off, then this could potentially be a 10-to-1 return. The Hong Kong trade for boot campers potentially has a 100-to-1 return. And again, we have about 1% of our portfolio in these positions. So it's not often I like to take speculative trades, but there's enough tensions and problems in the market to really make the case that we do want to risk around 1 to 2% of our portfolio in these potentially 30-to-1 and 100-to-1 trading opportunities. So just one of those bets paying off can deliver the total return we need for a full year with very little risk. So total allocation with everything is under 90%, depends on how much you paid for your puts on the SPY, as well as how much you paid for your TLT call options, and you have about 10% in cash. Now, if you're following the basic program, you really have just about 10% in options and 90% in cash. So that's how we're currently allocated. Expect to sell our TLT calls, SPY puts, USO puts, GDX puts, FXI puts and emerging market puts between May and September to free up capital to rotate into our 5 target long ETFs, which again are healthcare, XLV, biotech, IBB, medical device, IHI, e-commerce, ONLN, and Aero Defense ITA. So that's our positioning. How are we performing? In the pro portfolio with the boot camp, we're up 0.68%. We had up to a 15% return in March. TLT went to 180, and that caused central banks to sell their bonds and protect their massive, massive equity positions. We're talking people like Japan, Norway, who have these huge $1 trillion US equity positions. So that's unfortunate that we didn't sell our TLT calls at the top. But again, I do see us seeing TLT blow through 180 in the next big crisis. And that's probably when we're going to start looking for a rotation to take profits on our TLT position, expect a pullback in the TLT, and jump into some equities, which again, I think is going to occur towards the end of this summer. And we'll look at fundamental analysis as to what are the catalysts that will potentially cause that. The basic membership, we have some drawdown. Again, this only trades US equities. We're down 8%. Most of that was derived from buying puts that we're just holding onto. And that, again, provides 2 years of downside protection. And if you were to cost average out that drawdown for 24 months, then really the drawdown we're experiencing right now is not very bad at all. The trading opportunity on those puts, if we do break into new lows, is anywhere from 500 to 5,000%, and could be the only trade we need this entire year for the basic portfolio to do extremely well. Now, that's not the last trade we have in mind, because once again, we do want to rotate into this group of companies who will really thrive from all the money that's being raised by the government and being stimulated. Now, many sectors in the S&P 500 will be kept on life support, and that's why I don't want to just buy the SPY when I think there's a bottom, but rather the companies that are going to truly benefit from the paradigm shift happening in our economy. So we'll take a look at what that shift is and why these companies really benefit in a moment. In our buy and hold portfolio, no changes. And again, I don't expect to change anything in this until summertime. A target is look for a 180 TLT price point, and that'll quite likely be the signal to rotate into long positions in equities. Okay, Murray says he can't get Schwab execution. Are you doing a, if you can't get the 4, then I would go down 1 strike. And then do a market order, not a limit order. And you might want to fill that in little batches, Murray, if you're having time, because I know you have a large portfolio, so you're looking at getting quite a few puts filled.
Yeah, and Murray, it's probably good to call him too, but you might just need to expand your option chain within your brokerage account too. Yeah, I just call him too.
So in our buy and hold, we have the exact same strategy. There's no USO in our buy and hold at this point in time, but you have your inverse ETFs in Tex, FAS, Yang. So Tex is your technology companies. Ad revenue is quite likely going to drop sharply in 2020, and the companies in that sector and that ETF will be punished if that's the case. FAS, the banks, they've been in bad territory. If you look at banks internationally who've been suffering from negative or low central bank interest rate levels, it's quite clear that there's a lot of downside risk for US banks if we remain at 0% interest rates for a prolonged period of time. And we may very well have to dip into negative rates. So that's really the 2 core reasons to be long those 2 inverse ETFs in our buy and hold portfolio. Yang benefits from China going down. So there's really a handful of really nice ETFs to play China. MCHI and FXI are the 2 big ones. MCHI has a big position in Alibaba, which again, I think will be a relatively strong Chinese company. However, FXI strips out Alibaba and has more exposure to the companies that I do think will be much weaker in China. Now, the real big play to bet down on China is that we expect there to be US political actions taken to punish China and try to slow them down from potentially becoming the most powerful country in the world. And that's really an easy prediction to make for the next decade. But considering what's just recently occurred, I can see the entire November election campaign circling around, blaming everything on China. So Yang is your easy way to play FXI through an inverse ETF. And again, we still have our 30-year Treasury position, TLT, and we still have the gold miner position. So per $1,000, this is the number of shares to own. And we're not worrying about the percentage allocation. We're just keeping these ratios and understand that the value of the ETFs will go up and down, and that we're really going to be looking at timing to change our positioning. And that timing will be quite likely when the TLT gets close to 180 or breaks through 180. And I think that'll be a pivotal moment in time to reallocate capital and take advantage of what will quite likely be a vicious downward move in stocks. Didi, no, USO is not in the buy and hold at this point in time. So it's in our pro membership strategy, which we trade on Thursdays typically, but because of this huge drop in WTI, a record-breaking drop, we jumped on it today. Mike says, do you think the US can risk taking significant measures against China when they control so much of our supply chain? Medicine, Apple, every electronic. Yeah, he's got a great point. So the great decoupling, that's really what we're looking at. Timing of that will be difficult, but with this administration, we've seen them be very aggressive. And so all that we really need now is for them to fail to meet their phase 1 trade agreement, which had an out clause. It had an out clause they added in, which funny enough mentioned a act of God or a pandemic that causes China not to be able to meet their obligations, would let them off the hook. So I'm sure they'll be using that. Would be more interesting is if they did meet the phase 1 deal, which would make it even more difficult politically for the administration to take those actions. Regardless, though, I do believe equities are in severe trouble no matter what the administration does and no matter what the Federal Reserve does. So this is not malinvestment that's been made by bankers this time around. This is an invisible enemy that you just can't stop the havoc it wreaks. Pat says, on that note, do you think the Fed can decouple from the market with all the QE and QE bonds and the promise of... So they're not promising QE forever, and they've been gradually reducing QE. QE is counterproductive for what their real goal is. And so they want to fund the US government with trillions of dollars to patch up all the holes in our cup. Think of the US as a cup. Well, the invisible enemy has gone through and eaten small little holes all through that cup, and they're busy trying to plug it. In order to plug it, they have to incentivize the buy and hold into US Treasury products, not the buy and sell. So quantitative easing incentivizes these big banks to take a risk-free profit on their bond position and to buy stocks. If they cut off QE, which they have been doing, that does the exact opposite. Jeff Stone, since you aren't adding USI to buy and hold, are you expecting it to go even lower? Yes, I do expect a risk of it to go lower, so that's why I have the put option to protect it. So really using put options while going long an asset is a beautiful strategy when you think there's substantial upside ahead. And so just to get back to January levels, we're at 13. To get back to 2015 levels, we're somewhere around, I believe it was 30 or 40, which I don't think we'll get to that level. But exactly, and that's why we didn't put in the buy and hold at this moment in time. Julio says, what's the expectation for Yang with respect to the TLT? Any changes soon? No, I think we'll be making changes this summer. So just for a timer, once we hit 180 on the TLT or either break through it or get very close, that's when I'd expect it's time to buy stocks and to sell all our TLT call options, sell every put option we're still owning, and then buy a in-the-money put to protect TLT, because I do believe we'll see a pullback on the TLT and a bounce in stocks at that level. We haven't changed any of our SPY puts, Jack. So the only change to the portfolio, again, was to add this position today. Okay, Randy says he got a video from a friend in China indicating they found the virus in the water in Paris. Not sure if this is true. Okay, great. So I'm going to go into some analysis. I've got a very, very in-depth presentation to provide daily now. And we'll take a break at the 11 o'clock mark, Mountain Standard Time, to review our product options with Dean, because he does have a super busy schedule with coaching calls. And then we'll go back into the presentation content. So, okay, great. Is everybody clear on the trade alert, how to position your portfolio? Because now we can jump into the analysis.
Hey, Jason, I think Pat had an additional question. So Pat, if you have your microphone, if you want to just jump in real quick and ask it, go for it.
Well, let's wait to do audio questions until I've gone through all the I'm sure it'll be covered once I go through the analysis. Let me go through some analysis, guys, and
Okay,
then we'll
cool.
see what questions we have. Okay, so why do we think there's a stock crash coming? What's going to happen with the Fed? What's going on with all these different markets? Let's take a look. Okay, so we all know that there's something unusual about 2020 that is dramatically changing our lifestyle. And that is, again, the, we'll call it the honey badger disease. We all know what it is. We can't say it, otherwise we'll get censored. And this is really critical to predicting the markets. Now, to start the year out, I had the exact opposite prediction. I was thinking mild global growth, emerging markets will outperform US equities, and that the TLT should crash because everything's going to be rainbows and ponies. And quickly into January of 2020, US equities were flying high after the phase one trade deal, which was great for China. It was great for US, at least the phase one portion of it was. But suddenly, China's stock market was crashing. And so I'm trying to dig into what on earth could be wrong this time. This was supposed to be the big run for emerging markets. Everybody's been pitching that for decades. And where was it? It was tanking. And all we could find out was that there was a novel virus spreading through China. And that was really what was causing the disruptions. Pretty soon, China shut down a $1 trillion a month economy. And remember, the leaders of China pocket 70% of all the income to their population. So they have a massive tax rate. So all of the wealth of China goes to a few elite. And that's what makes China so powerful, is that there's a handful of people that can manipulate any government under the sun with bribery. They can take over any industry they want by taking the full wealth of China and subsidizing that industry. So Huawei is a great example of that. And they have plans to take over a lot of key industries in the future. And that's really what this trade war is all about. So we caught on to that early, flipped the trading strategy to be short stocks and long bonds. And we've done quite well. There's a moment where we were up 15% in a month. We try to make 15% a year, but we had that in a single month. And then the crash was so significant, it did cause central banks to take some of their profits off the bonds to protect their multi-trillion-dollar equity positions. So that's the same play that's still underway and nowhere near complete. And I'll show you proof that we're nowhere near the bottom of this slowed economy, and why, if you can predict that corporations are going to have earnings declining, and you can predict that the government's debt is accelerating, that this is the best way to play the markets. Okay, so this is your deaths total on a log scale. So log scale looks a lot different than normal. So if I go to the normal, you can see this looks like it's going straight up. A little bit of a slowdown here on the weekends. Weekends tend to have low reporting. But if we go to log scale, this is what I'm really interested in, is trying to see the log scale death count flatline. Okay, so if it's going up at all on a log scale, then it's growing at an exponential pace. So that's step one, is to understand that there is an invisible disease floating around the world that spreads from children to parents, from parents to grandparents. That's virtually impossible to identify. The kids have no symptoms. They spread it for months. The parents may or may not have symptoms, and then they spread it for up to a month. And then it really wreaks havoc on people with any kind of health deficiency. Okay, so that's what's really disrupting our economy, changing consumer behavior, and what we need to be on top of to predict when the stock market will rebound and when the bond market will top out. And so here's a little chart table we've created to help predict this. And so there's 7 billion people, actually there's 7.1. We're going to anticipate that 50% of the population is at risk of catching this, although it's quite likely more like 80%. We've seen a number of small areas that are infecting about 50%, whether it's anecdotal stories of a family home or a cruise ship or a Navy ship or just any kind of closed area. We're finding that about 50% are at least being identified as having the virus. So this could very well be 80%. Okay, of the people who catch it, we are finding that half of those will have no symptoms. So there's a lot of data coming out where they're going and testing random groups of people, and a lot of people just have no symptoms whatsoever. They are catching it, they are spreading it, but they're having no symptoms. I'd say it's about half and half. Half have no symptoms, half do have symptoms. For this model, we're going to go ahead and downshoot that estimate. So we're going to just say that because of the data we do have is biased towards very sick people, and that we're less likely to have data for non-sick people, let's assume that it's better than the statistics we can work from. So I'm saying that 1/3 will actually have an issue who do potentially catch this. Okay, so that leaves us with 117 million people who potentially need hospitalization. If we assume 10% that do show issues will need a bed in a hospital. Okay, now this is where we really run into problems, because this level of hospitalization is requiring ventilation and really an ICU room. So there's currently 100,000 ICUs in America when this all began, with about 10,000 spots open. And so this is telling us that potentially we're going to need upwards of 120 million ICU patients over the course of this virus spreading. Now, this does anticipate that this would bring us herd immunity. So there's really two ways out of this mess. It's either herd immunity or we get a vaccine into 7 billion people. Either way, it's a long ways out. So for us to try to predict when the economic turmoil is going to hit a peak, we have to get closer to 50% of the population has had it. And that's going to really be when I believe we're getting near a bottom in economic slowdown. So there's nowhere near enough hospital beds to take care of all these people. If we just look at the US, this is still showing that we'd potentially need 5.7 million ICU beds spread out again over a course of potentially 12 to 24 months. And there's nowhere near this many beds in place. So that is why the government must go in and out of lockdowns, whether it's the entire nation or it's select little areas where there's hotspots. We can predict that every time the hospital center in a city becomes overwhelmed, that city will have to go into a lockdown. And if it becomes a systematic problem throughout the entire US, you can see the entire US right back into a lockdown. But it comes with the catch that saving human life wrecks your economy. So I do anticipate that despite the administration wanting to get the economy back open, despite Las Vegas wanting to have the Wynn back open by mid-May, every time you start to do that, you're going to get a huge surge in infections. You're going to max out your hospital system and be right back into a lockdown. And even the so-called reopening of the economy, it's not a full reopening. It's highly, highly controlled. They're still going to be very cautious about letting public gatherings occur. And if you just go to Home Depot or Lowe's, you can get a feel for what that looks like. And that means standing in huge lines to get in and out, one person in, one person out, everybody's 6 feet away wearing a mask. So that consumer behavior is changing and probably won't ever go back to normal until you're not worried about a disease that can make you sick for months. And now there's Reddit channels with people who have had it, and there's plenty of 30-year-olds complaining that it's now been 2 months. They can still barely get up and walk around. They can barely breathe. And there's now more and more indications that this is not something like a flu where you get over it, you're good to go. This could have long-lasting ramifications on your health for the rest of your life. So something more like HIV or something of that nature. So it's still very early to predict what the long-term ramifications of this are, but surely people don't know just how nasty this is, and we're nowhere near getting herd immunity. So if we do look at the current amount of dead and use this model to predict when we could hit herd immunity, we can note that currently we've completed no more than 5% of the spread to the general population, and potentially as little as 0.5%. So if this was an hour, 40-minute movie, we've watched between a half a minute and 5 minutes of the movie. So we're just getting started on what this is going to do to the economy. And again, that's because very few people have it, very few people have had it, and this will continue to force governments to go in and out of lockdowns. So that's something we've been very good at predicting, and again, will be quite likely why stock market has to have an extreme revaluation relative to where it was in 2019, as the profits and earnings just won't be the same. The companies that thrive will be different. The companies that were doing just great in 2019, many of which will be completely wiped off the planet here. So this shift of wealth is going to be very, very frightening to watch as unemployment quite likely spikes to levels we've never seen in history. Okay, so let's look at some other data on this front. And again, we'll look at stock charts. I know everybody looks, why are we looking at health data to predict the markets? But this is critical, absolutely critical, and why we were able to get investors out of stocks in January, well before this all transpired. Okay, so in the US camp, we've been in a quasi lockdown for several weeks now, and they're hyping up that they're going to allow the governors to make the call to reopen their economy. Smart move for the administration. On one side, you've got their core base having riots, gridlocking highways, protesting at government buildings. So from that perspective, you can understand the extreme pressure to reopen the economy. And then on the other side, you got a group of people who want to remain locked down for much longer. Now it's been pushed off to the governors to make that call, and I think that was a smart decision, although I do anticipate we'll quickly see anyone who is brave and tries to reopen their economy quickly being back into precautionary measures. And we'll take a look at why in a moment, but look at, here's your US logarithmic scale, and so it's still growing at a log scale. I'd expect this will flatline as we go into May. And then as places like Las Vegas, Florida, just anyone who has a lot of people in a close proximity trying to reopen their economy, quite likely this will start to skyrocket back up after we've reopened the economy for give it a good month. So we'll see who actually opens their economy and at what scale. No matter what, it will definitely be at a limited pace and probably result in going back into lockdowns when they realize that, number one, they did it too early. They did it before they had extreme testing available for not just the virus, but also the antibodies. We don't have masks for everyone. And a lot of these businesses that do want to reopen, like a casino, for example, are an absolute disaster waiting to happen for spreading this. So I just definitely speeds up our timeline to get to a bottom. So the sooner we can get to herd immunity, which again will probably be once we hit half of our total death count. So if we hit 15 million, that's when we will, quite frankly, be very close to herd immunity. So we're just nowhere close to that at 164,000 reported. Okay, so let's look at some other countries. How are they doing? So with US, I'm primarily interested in the death count, and it continues to grow at a rapid pace, but you can see on a log scale, it does show a flattening, which is good. But again, for this really to work, they should keep the lockdown in place probably for another month at a minimum and make it more extreme than it is currently. They're not going to do that. So I would anticipate this just flat lines and then starts rocketing higher the faster governors open up their economy and relax restrictions. So that's what we are expecting in the US. And again, we're just nowhere near having enough of the population infected to develop that herd immunity and be able to confidently go out to public and not be worried that the guy coughing next to you or even just breathing next to you could potentially give you a lifelong disease that could potentially kill you, no matter what your age is. Okay, Italy did an extreme lockdown, and we're starting to see their logarithmic death count flatline. So it works. Lockdowns work. They flatten curves, but the second you end the lockdown without herd immunity, without vaccines, without masks for everyone, and again, if just a handkerchief's not going to do the trick. That's kind of like thinking a radio wave would be blocked by your wall, not even close. You really need that N95 mask. And then you have to be smart about putting it on and off, because that could quickly become a contaminated rag that you're carrying around versus a protectionary piece of equipment. So there's a lot of education that has to be rolled out to really fix this. Spain, extreme lockdowns. We're seeing their death curve flatline. So that's good. We'll keep a close eye on it. Are they going to get brave, open their economy back up? And the bottom line is they all have to open their economy back up to some extent. Otherwise, everyone's going to starve. So it's really just an untenable position that governments are in right now. Save lives, make everyone starve, feed everyone, but you're going to tax your medical system and extremely tax the elderly who are at the highest risk. Okay, Germany, a lot less. Interesting that their count is so much lower. A lot of countries that are partnered with China, for whatever reason, have a much less death count. So Germany, Russia, and China, as you'll see, have far lower statistics on all this. Here's the UK, again, starting to flatline at 16,000 deaths. We'll see if they make the same move. Japan just wasn't counting anything for quite some time, as they were really excited to have the Olympics this summer, which again was postponed at least a year. And now their case count and death counts are starting to pop up. So again, we're looking at the big economies. Singapore, I'm looking at confirmed cases at this point, not the death count. So Singapore has done good at keeping people from passing away. But this was really your hope that hot weather would do the trick. Now there's some data coming out that you literally have to go to 115-degree temperature for 15 minutes straight to melt away the protein shell on this virus. So hot weather is not doing anything whatsoever at all. And Singapore is great evidence. Their temperature day and night swings between 80 to 100. And you can see this is the most advanced civilization on the planet with the best healthcare system. And they can't keep this under control. So that's a bad sign. And this is growing at an exponential rate for active cases in Singapore. And also, again, this is not looking at the death count right now. They're so early on with this that we're just looking at their active case count. Okay, here's China's active case count. Their data we know is very phony and potentially being used for political reasons. But what I'm interested in is they were the first to have this, first to do the extreme lockdowns. And now they're the first to really go full blown and open back up their economy. So it'll be interesting to see if they have a huge spike that they'll report in active new cases. So I'm interested if they're going to be really spewing out propaganda that scares everyone versus trying to make us feel like it's really a controllable disease that their methodology worked just fine and dandy. So we don't trust their data, but because we don't trust their data, if they are spewing negative information out, that's a good heads up, especially for all of us betting down on China in various manners, from FXI to being short the Hong Kong dollar. Okay, we got South Korea. They did some extreme, they just went completely extreme with shutdowns, massive testing, really taught the world how to do it right. And so they have extremely flatlined that logarithmic growth of confirmed cases. And so also being a US ally, very interesting to watch what's going on in South Korea. So if they've also been reporting a lot of people who were released, over 150 now have come back with the antigens showing back up in their blood. So they thought these people had beat it. They're coming back a month later and they still haven't. That's very, very concerning because we're all assuming that if we get it once, then we can have antibodies in our body to fight it for at least a year. And so we know that perhaps if it's mutating every year, that we may need slight variations via a vaccine to fight it for the foreseeable future. Okay, India. The poorer countries with huge populations seem to be just not testing very much, at least. So in India, we can see that the exponential growth of confirmed cases is going up. And again, they have very, very little luck getting poorer parts of the world to stay into any kind of quarantine whatsoever because they're more concerned about food. Okay, Indonesia, same story, still growing at an exponential rate. Probably, as you can see, very little testing. Pakistan, same thing. Brazil, same thing, although they're now at 39,000 cases. Nigeria, similar. I think they're just now barely starting to test. Bangladesh, same thing, growing exponentially. Russia, now they were very quick to shut their borders without any cases whatsoever, but now we're seeing their cases grow exponentially for confirmed cases. And same thing for Mexico. So the bigger the population and the poorer the country, the less testing going on, the least isolation. And so we have a huge breeding ground. So unless we anticipate shutting down all international travel, the chances that we can really curtail the spread of this is zero. So that's really the point of all this, is to understand that this is just getting started. If you thought of it as charging your phone to 100%, we might be buying stocks once we've charged our phone at 50%. Well, In the best case scenario, we've charged 5%. In the worst case scenario, we've charged less than 0.5%. So the impact of all of this is really just getting started. What are some things that could change our opinion on this? Well, therapies less so. If we get some therapies that might help allow the government to have more economic activity, but it's still going to put a flood of people in the hospital system, and that's really the limit to what we can do for opening the economy. Is we can really only open it so much that we don't max out our hospitals. Second, we max out the hospitals, expect extreme lockdown measurements rolled out, at least in that isolated area. What would really change the game is, again, a vaccine, because if a vaccine did work, this could eliminate all these problems, all these core problems that are slowing the economy. Now, there's always rumors coming out. The other thing that would potentially change our opinion is if this had already had spread rapidly through society for much longer than we thought. It was less dangerous than we thought, and more people already were immune to it. And again, that's why I have the tenfold, I call it the antibody risk. So with our predictions of trying to get a bottom in stocks, I'm really timing it based upon when I think the full brunt of this has been impacted, or at least the climax. And again, I'll be ready to predict that at 50% or a vaccine that works. So with the antibody risk, we're taking where we think we're at currently, which is based on the death count, is at 0.5%. And then we're multiplying that by 10 for the antibody risk. So at the low end, I think we, again, completed 0.5% of the spread. At the best case scenario, we're looking at 5%. So this news feed helps me keep a close eye on any data coming out of antibodies. And they're supposed to really hit this full stream on Tuesday with the Abbott testing machine. So we'll keep a close eye on that. But I don't think we'll be off in our range. And regardless, we're nowhere near completing the damage. A vaccine would be great news. Bill Gates has his hands on half of them. And what's interesting, it appears Dr. Fauci has some patents related to what's being developed as well. So very interesting in that regard. There's a lot of vaccines being pushed right now. And again, to properly test them does take at least a year. So I don't think we're going to be seeing one before May of 2021. And despite them getting the manufacturing in place to massively roll these out, that could still be quite a while. Now they're talking about a vaccine that will also tattoo you with an invisible tattoo when you get the vaccine, so you could easily be identified before entering any sort of store with this. So if you want to go down the conspiracies as to what Bill Gates is up to, that is certainly alarming. Now, treatments, again, could help the capacity for a hospital, but it's not going to stop the spread and people who get sick and end up going to the hospital. So, so far, it doesn't seem like there's really a miracle cure. If you catch it early, maybe there's some tricks that help, but in the same breath, already very few people who do catch it actually end up in the ICU bed and need any medication. Their natural immune system can beat it. So I would be very skeptical of any certain drug being a miracle cure at this point, because again, doctors know about all these drugs and they've been testing them, and the death count still rises at rapid pace. So, okay, so that's a look at the core reason the US economy, global economy, is going to be at a slowed pace, and why we want to be long bonds and short stocks. Again, we're expecting profits and earnings for corporations to drop relative to last year significantly. And at the same time, to really fix the problem, the government has to raise trillions of dollars, bail out the economy. And so that's why we want to be long bonds. We'll get into that in more detail. Let me go to the next set of charts. Okay, so this is a chart that Jeffrey Gundlach loves to point out. We have some big indexes. We have the Dow in black. In purple, we have Europe. I'll go down from color. So in black, we have the Dow. In yellow, we have the Japanese market, the Nikkei. The Shanghai Composite, China, is in turquoise down below. Emerging markets, which is correlated to China, obviously, but also includes South Korea, India, Russia, really the whole area, ex-Japan in pink. And then we have Europe in purple. And so if we go back through time, this is what Gunlike's been predicting, or really pointing out recently, is that each index tends to have a blowout top and then never recover. So what we can see here is first, we have the European market in the 2000s outperforming everyone and crashing. Let's see if we can get the Japanese market. Oh yeah, okay, so here is the first blowout market. So this was Japan, 1989. Their real estate, Tokyo was valued at more than all of California, and they had a decision to make. What are they going to protect? Their stock market, their real estate market, their currency / bond market. They chose the currency market. And so their stock and real estate has been suffering for decades since. So that's a well-known story and is exactly what I expect will happen to Hong Kong. So Hong Kong allowed themselves to create lots of debt to allow their real estate prices to go sky high. And now it doesn't make sense to maintain the costs of Hong Kong. So it's in the same predicament that Japan's in. That's why we like that short Hong Kong trade with 100-to-1 potential return. Okay, but we go into the future. Stocks crash, they rebound. What was the next big performer? If we zoom in, we can see going into the dot-com bubble. Everybody knows US stock market did great until it tanked. Amazon crashed, I think, 98% in that crash, which was just insane. Imagine picking up Amazon at 90% off. But it was it was the European market that really outperformed in 2000, as the euro was going to be the savior of everything, although that didn't pan out very well. And so you can see the European markets been underperforming since then. Now going into the 2008 crisis, we can see the hot pick was emerging markets, as well as China, outperforming all assets. And then for the last decade, they've really suffered and underperformed. And again, this was primarily due to exposing China's business model. Was really not a great business model. They've built the biggest real estate bubble of history, and is on the verge of collapse outside of Hong Kong. But China has really got a lot of economic troubles, and we can see their market never rebounded. And now the market that's really outperforming everything is the US market. Although we can see the Japanese markets performing slightly better. This is 2/3 of the Japanese market is owned by their own central bank. But most recently, you can see the extreme outperformance was in US equities from 2016 until we hit the top, 2019. And again, our expectation is a massive crash. Now, a lot of people are trying to anticipate that emerging markets will emerge as the leader after this. But again, they've been predicting this for quite some time. So that's just a big look at the major stock indexes. Who's most overvalued? And clearly, it's the US stock market. Okay, so let's look at the next chart. Okay, so we're looking at the S&P 500, and we have a few different indicators. The blue dots are support and resistance. The wavy lines are Fibonacci levels, and then we have a moving average. So 2008, you managed to knock half the value of the US stock market right off the planet in a year. And it was caused by $300 billion in bad mortgage loans, which were turned into derivatives, probably totaling $3 trillion in value. So what happened? Well, a bunch of people stopped paying their mortgages, about 30% in these certain bracket of bad loans that were being sold as a AAA rating to pension funds and everybody else. And so people were digging into what was underneath these different mortgage-backed securities, and they're looking at the real assets in there and seeing that 30% were just not paying their mortgage. And all of a sudden, everybody realized it was time to get out of Dodge. So how did the government and the banks deal with a small loss of $300 billion in bad loans that were packaged into $3 trillion? So banks love when companies struggle because they can come in, loan them money with what's called a convertible notes, a popular strategy, and it's really a great deal for a bank. So if your company's in trouble, but the bank thinks it's a short-term problem that can be resolved with cash, they'll come in with a high interest convertible note. So if you fail to revive your company and go bankrupt, they get first dibs at all your assets. If you do survive, then they're going to get their money back plus a huge interest. But if you survive and decide not to pay them back, then they can convert it into a huge chunk of your company, which will be likely trading at a great discount. So banks love troubled companies. But what happens when a single bank can't purchase all of the bad investment because too many companies are failing at the same time? So that's what was happening in 2008. The bankers between meetings were going to the ATM machine, pulling out as much cash. They were afraid they were moments away from the entire financial system coming to a complete halt. The only thing that saved it was $3.5 trillion of money printing. But first, they had to do something else. And what they did first is absolutely critical for our entire strategy. So what did they do? They cut interest rates to near zero. And that's when you got the stock crash. Then at the bottom of the crash, they bought the bonds from the banks and did quantitative easing. And that's when we got the stock rally. So what's the whole strategy? Well, right now, we have a problem that's far greater than $300 billion in bad real estate loans to a small minority group. Right now, we have potentially a huge chunk of every mortgage, whether it's commercial or real estate, deferring payments or not being able to make payments, period. So if you just look at the real estate crisis ahead, from people not paying rent at a corporate level, at a small business level, and at a retail level, it's at least no less than 10 times worse than what we had in 2008. At the same time, the market is at least twice as leveraged as it was in 2008. And the debt levels, again, are magnitudes larger. So the extreme leverage in the market is much more extreme today than it was in 2008. And the financial crisis we're facing just in real estate alone is at least tenfold. That doesn't even take into account that many companies will outright go bankrupt and that very few companies' current structure will really thrive in what's really coming out as the new norm. So 50% crash took a year. What was the game plan? Step one, they cut rates to near zero. The goal is just to make the federal fund rate below the yield of the current Treasury bond. So the game plan here is the same that we've seen the banks do on a small scale. They're going to partner with the government to do the same thing. So the central bank will loan Jpmorgan money, any primary dealer money, for a low interest rate. Right now, that's nearly at zero. They turn around and they have to buy all of the US debt. So they do this when they know the government's going to issue a lot of deficit debt that they cannot collect from taxes. So that's happening at the fastest pace in history right now. We've promised $2.2 trillion in stimulus, but now they're going to probably throw another $2 trillion in for the infrastructure, more money for small business. If we continue to have more lockdowns, then we're going to have to probably print another $1 trillion for just people who need to stay at home, who want to keep paying rent, but they're now unemployed. So the costs for the government for 2020 and 2021 are just going to be absolutely insane. So that's why the Fed has to cut rates towards zero, which allows the primary dealers who have to, by law, buy all of the debt the government's issuing, whether they like it or not. So they can borrow for free from the central bank. They can buy up the US debt. And if there's quantitative easing in place, which there has been for the last 4 weeks, then they can sell that debt to the Fed for a profit. But that's not the plan that the Fed wants or the government. The government wants to sell all the debt first. And then after that debt's been held and reallocated into the economy and the economy's been fixed, then and only then does the Fed come in with QE, vacuum the debt off the hands of these big banks for massive profits, and then the banks can come in and buy stocks for cheap. And so that's the 1-2 combo punch that gives you the stock crash and then the big rally. And so the money supply increases dramatically over this period of time, and the banks get 2 huge paydays. First huge payday is buying that debt from the government, knowing very well they won't be selling it in the open market. They're going to sell it back to the Fed for a profit. We'll take a look at that, how that bond market works. Once they cash out their government debt for a profit, then that's when they buy stocks because they've freed up their cash flow. And that's when you get your rebound. Now, again, the magnitude of this crash or this problem this year was greater than the 2008 crisis, probably by at least a magnitude of 10 on the short end. But I would say it's potentially to the magnitude of 100 times worse. So the Fed had to come in and do a small amount of QE, and that small amount is almost $2 trillion. To save the market, and it's lasted them a month. But if they continue to do that, they won't be able to raise the capital for the government and fix the real problem we're facing here. So that's why we've seen the Fed stabilize the market and start to drop QE every week. So we've seen them go from 65 billion a day to 50 to 35. This week it's only 25 billion. So that QE is buying the product we're holding, but you got to realize that's allowing the big banks to cash out some of their treasuries for a profit today and to try to protect the stock market at this point in time. As that continues to drop, the incentive will be to buy and hold debt. And again, there'll be no support for stocks. So this trend is happening week by week. We get that update every Thursday in terms of what they've actually added to the balance sheet. And then on Friday, they do announce what their plan is for the next week. So every week they've been dropping that down significantly. Okay, so this is the look. And again, once we put it into the grand scheme of things, it's really foolish to believe that no less than a 50% correction is in the books. Quite frankly, it couldn't be of a greater magnitude than 50%. So we're gonna have to be very protective and safe about entering into a position at only a 50% correction for those key ETFs we like. So again, we do have a smart strategy for how to do that, which involves owning those put options you're buying today and then selling puts against those ETFs we're interested in. Now, depending on what happens with the lockdowns, I either see us getting a full crash into the rest of this year and we get towards that herd immunity faster, or we do a mini crash towards the end of the year, which I still think will break the recent low and potentially break past this 200 support line. Then get a rebound into the end of the year, and then only to figure out that we're still a ways off from a vaccine. And the longer the vaccine takes, the longer this correction could last. Okay, let's go to the next chart. Here we're looking at a daily chart. So you can see we did tap that upper bound. We're still above the moving average. And I think we have maybe a month at most to wait for the next leg down, although it really happens when you get big players deciding to pull the rug out from underneath everyone. So it's unfortunate we didn't buy some expensive calls and make a little money on this upswing. But the big picture, the big gains are really going to be just being patient, understanding that the economy is really in a bad position, and that's not going to change anytime soon. What comes next is the Fed starts to taper off the QE, and all the bad economic data just mounts week after week after week. So Q1 probably won't look too bad. Q2, Q3 are going to be dismal. And it is at some point in Q3 when everything is at the peak of its looking as bad as it possibly can that I want to buy stocks. So
Jason, just real quick, but I have to hop off to get on some calls. Would you mind going over the options real quick? And,
yeah, let's do a quick review of the products really quick.
Okay, cool. And quick heads up to GDX just past 31. TLT is sitting at 168 and change. And USO is up a little bit already too. So just kind of heads up on everything.
Great. I'm going to take a 2-minute break here, Dean, while you go through the products. I'll be right back, okay?
Okay, cool. And saw a couple huge dark pool prints in USO too. So
nice.
Phenomenal timing.
We have a lot more content to go over, guys. So we're just going to do a quick break to review our programs and get Dean to all his appointments. And then I got a lot more content to go through with you guys.
Okay, Charles. So real quick, it's Dean again. Sorry, I have to hop off here in just a minute, but schedules get busier by the day. And if you are on a trial, there's a couple options for you. Okay. And then also, guys, we have a new team member that's going to be reaching out to you to schedule my calls. Because I basically don't have the time to do the scheduling process. Okay. But his name's Damien. He's awesome. He's great with detail. He's a really nice guy to talk to. We'll be reaching out to you if you're on a trial to set up a time to chat with. Okay. But so real quick, guys. So if you have less than 30K to invest, the buy and hold portfolio is going to be best for you. Okay. It's less than $1,000 a year. It did really well last year, did 23% last year. Biggest drawdown was 1.6%. But great if you have less than 30K. Okay. Now for basic, that's a phenomenal portfolio, guys. If you have between $30,000 and $75,000, okay. Right now we're positioned into, a crash in the stock market. Okay. A coming crash in the stock market with beautiful time duration set up for that. Okay. We will tell you when to get back into equity market, but it's probably not going to be anytime soon, as Jason was just talking about. Okay. And guys, when you do upgrade to the basic portfolio, so like I said, it's great if you have between 30 and 75K. We are giving you a 30-day access to the bootcamp program while we have the spots. Okay. And that's more than $1,000 bonus for free at no cost. And there's some phenomenal educational aspects of the bootcamp that are sitting there waiting for you to take advantage of. Okay. So there's literally, I would say 30 hours worth of content that once you make your purchase, you'll get your login, Ryan. Okay. And that login will allow you to start devouring that education today. Okay. You don't have to wait for the next live session. We've recorded all of our live sessions. You can start going through that today. In the pro portfolio, it's fantastic for clients of at least 75,000 or if not a lot more. Okay. The typical client using this probably has a couple 100,000 behind it. And I think we're up to about, I want to say 40 to 50 people that are using more than $1 million for pro portfolio. Okay. And I think this is about 4 million. To say you have to have that, but the minimal drawdown is why this is such an attractive program for investors that have a significant amount of capital in the market. Okay. And last but not least, you do have the bootcamp option. Okay. And so it's really cool, guys, because you're going to get a lifetime access to our bootcamp program. And as the bonus there, we give you 1 year free access to the pro portfolio. Okay. And it's a phenomenal way to just build your education base, get your foundation on how to think like us, right? How to think like the resilient hedge fund managers on the planet over the last 20 years. Okay. And really just have a blast, from kind of level of trading to a pro level of trading. And yeah, guys, if you have any questions, just text me your questions or call me. I will call you back when I do have time between all of my calls that I have for the week. And as Jason just said, top right corner of my screen, of your screen, it's 505-275-15. If you don't have that number saved in your phone, guys, feel free to save it now. But what I'm going to do is just, post the options link into the chat box. And then what you can do is simply copy and paste that link into your web browser and get started from there. Okay. And folks, look forward to the honor and opportunity to showing you how to build wealth in the new world. Okay. And, helping you with your education and ultimately to benefit you, your family, okay, your kids, your grandkids, and eventually hand them a massive asset. That's my goal. That's my plan. Look forward to showing that, showing you guys how to do that with Jason's help. So thank you. Appreciate your time, and can't be on longer, but hope you all have a great day and enjoy the new trade.
Excellent. Thank you so much, Dean.
Thank you, Jason. All right, guys, have a wonderful day.
Beautiful. Okay, I'll continue. We got a lot more content. Okay, let's look at a few questions in here. Jeff says, this is an awesome program. Current oil May contract is under $5. Crazy. Ross says, Jason, so September will be really tough. Yeah, I'm afraid that we're nowhere near the hardest point of what's coming our way. Craig Dennard says, will I be adding USO as well? Craig, which program are you following? The pro, the basic, the buy and hold? The buy and hold, I did wait to say to buy USO because you don't get the luxury of the put options in that program. So I'll probably wait till I think we actually have a crash. Now USO, I've been saying I'd like to pick up some companies half off, whereas the oil USO 90% off. Well, we're at 90% off compared to 2015, and we're at 70% off compared to January. So I'm ready to make that plunge with the married put because it just makes it so hard for us to lose and sets us up for some massive gains, especially if the U.S. comes in there and bails out the oil companies, which they have to do at some point. It's just a question of when. Okay, so let's look at the SPY. Everybody wants to know when your put options are going to kick in here. I'd be shocked if we jump to above 310 or 300 is really where I think is the maximum this could go. Although with the Fed dropping their quantitative easing week over week at a pretty substantial rate, we could very well be at the top. So I was tempted to give you a little call option hedge against your puts today, but decided not to. And you can see I'm typically a fundamental value investor. And so I'm looking at what makes the most sense in the long run. And right now, buying put options makes a whole lot more sense than buying call options in the long run. Oil, in terms of USO is near the 90% correction I was looking for. And if the government comes in and just bails them out any moment, then that one could be at a bottom here. Now, the general stock market, no way, not even close. The Fed would have to print probably closer to $10 trillion to support the U.S. stock market and real estate market, which are really the two markets I see at extreme risk. You have small businesses that are going to go out of business. That'll be massively problematic for the employment numbers as well as the banks who hold these mortgages. So I do see that it's really not possible for the Fed to prop the market up indefinitely without destructing the dollar. And again, if they destruct the dollar, then all US denominated assets would lose value. So you'd see those sell off anyways. So not a winning position to keep every market up until you get your economy back to full throttle. You cannot get your economy back to full throttle until we're not scared of one another. It's just really that simple. Donald Dickey, oh, so glad to see you're back, Donald. I heard you had a surgery. We were worrying about you, and great to see you're back. So I'll go back to the trade alert to review that, but it was 2,000 shares with 20 puts at the 4 strike, January 15th. I've got so many windows open. Let's see if I can find the trade doc. Okay, so yeah, your new position today is a 2,000 share position in USO with a downside protection with the January 15th $4 USO put. If you have a large portfolio, which I know most of you do, and you can't seem to get enough puts purchased, the general idea is to have downside protection. So you could play with keeping the strike the same and going either a month or ahead or behind. And you could also go, Terry Grapevine says USO put costs $8,000. Well, it depends on how many. It costs $100 per put option approximately. So, but yeah, if you're having a hard time getting that exact strike filled, then I would either go down 1 strike, up 1 strike, or go back and forth with the expiration date until you have every share protected. The bottom line is we want to have some put option protection per. Marlene says, should I buy this with 30K? Only if you do intend to upgrade to the Pro portfolio, Marlene. That would make sense. Right now, until the stock market crash really goes full throttle, I've decided to provide the full Pro program in every update because otherwise your information as a basic member is pretty boring. You're just hearing me say, buy put options and wait till Q3 to buy stocks half off. So that's up to you. Okay, so stock market rally, what are some things that could keep it going? Well, the Fed would have to keep up at least 25 billion a day in QE to keep this at least in this general area. But I do believe, again, because of the big picture, because we have to fund the government, not the stock market right now, that they will continue to taper that off and that this will quickly flatline here. So wouldn't be betting too much on the S&P 500 remaining at this level for much longer. Again, the caveat would be if the Fed continued the $25 billion per day QE beyond this week into next week and weeks after, that could keep the market alive for a little bit longer. The May 1st opening up the economy could get some hype. So I do understand those are risks against our current position, but those are short-lived risks. And again, I would say at the worst case, we have another month to hold before the next big move down begins, and it could be much sooner than that. The crash in oil is always a good warning, and so that was something we had this morning and why we jumped on USO again at 70% off from a year ago, and our target for that's anywhere between $8 and $12 in the near future. We'll cover crypto, Ross. No safety in crypto. They are highly correlated to stocks. So I'll give you my where to buy crypto in terms of what I believe is good. Jeff says the Fed's balance sheet is now valued at 30% of our entire economy. It was only 5% in 2007. What does that mean? It means the economy is in very, very bad shape is what that means. We'll take a look at that. I have a lot of charts with specifically that. Okay, here's your short-term chart on the SPY. Really no change in outlook. Could we go up higher? Yes. Could we go up higher for another month? Yes. Okay, so I think your main main indicator for that will be the Fed's going to slow down QE. And as they slow down QE, the market will run out of momentum. This is extremely momentous. The stock market doesn't like to stay still. If it just goes flat, that turns into a crash. If it crashes, then it turns into more selling. But really, the only thing that keeps it going up is big moves to the upside. So you can't keep it going up if you're reducing QE, and they've been dramatically reducing QE for the last 3 weeks straight. So that's very good for our positioning, and does make me skeptical to try to do any short-term bids on that. Julio says USO is 275. I see 392 on my screen, so I'm not sure where you're looking at that. Okay, let's go to the next chart. So in this chart, I'm comparing gold miners to emerging markets. Interesting comparison. A lot of people correlate gold to emerging markets, and if we do zoom out, you can see quite a bit of correlation between these two. Quite remarkable, actually. Trading almost in identical returns in 2008, crashing to almost the exact same levels in 2009, or towards the end of 2008. Now, rebounding nearly the same as we did QE for the first few years. And then once we started playing with Operation Twist, where they're just changing the Fed's balance sheet of treasuries, which manipulated yields, they both came down at the same time. Similar rally here, similar crash here. So we can look at gold miners and emerging markets as potentially a good leading indicator for US equities. So in general, they look weak. And why own gold miners today when we expect a deflationary force and a stock market crash? And we know very well gold miners are highly correlated. Well, people are looking for ways to hedge their portfolio. The VIX is too expensive. They were buying that up when it was at 18. Now it's at, as of this moment, the VIX is trading at, let's see, we got 40. So 40 is very expensive. I believe we're going to see the TLT get to 180 and the VIX go to 100, and that'll really be a good time to be able to get into stocks. Probably around September is what I'm thinking timing wise. MHOG says, what's your opinion on UCO for smaller accounts? I'm not familiar with UCO, so I'm not going to comment on that. But USO is super cheap at $3.90 a share, so very affordable. I'll look at that at another time, MHOG, and see if I have commentary for it in the future. Okay, so there's your gold miner emerging market correlation. Very interesting correlation. We have the married put with the GDX. Is there a chance that central banks just keep printing their hearts out, all of them, at the same time, and that possibly gold miners break away from stocks? That's possible. So that's one reason I like having GDX, even though I'm anticipating downturn in it. One, two, I do want to have everyone holding GDX for a year at the earliest potential point to get the lower tax rate, because we do want to begin to build into silver after probably about a year from today is when I think it'll make sense to buy and hold the silver ETF. And so we'll want to be able to take profits on GDX at the lower tax rate and start getting in far early with silver. And I would anticipate the same married put strategy on spot silver when we get to that point. Again, I think that we're way early on that. Okay, next chart I have for us to look at is Ross says, what makes you determine how far away the strike price should be? Which one specifically, Ross? Okay, in this chart, we're comparing the QQQ in the black candlestick. Okay, so the SPY, I'm predicting puts that I believe the underlying asset will go below well before the expiration date. So I'm actually trying to make a profit from those in the tune of 500 to 5,000%, depending on which exact one you're looking at. The 5,000% is more on the longer duration, further out of the money puts, and the 500% in the closer. So those are designed to generate large profits and to also be left long as we initially enter the ETFs we're interested in. Now, if I give you a in the money put, then I want the least risk possible while I hold that position. So the married put strategy, which we're doing on SPY and USO, or rather on USO and GDX, we're at the time we're actually in the money. So we're actually going to get a higher price for the underlying asset than we even paid for it originally if the asset goes lower. So it allows us to have the least volatility if there's downside ahead. So there's a good case for why GDX and USO could potentially break paths from what they're so correlated to, which is S&P 500. And even if they don't, again, our plan is to sell those puts and remain long these assets. So it allows us to have limited downside risk, and we can still profit if they go up. Also, if the Fed reverses from decreasing QE to increasing QE, then these positions could rise rapidly for us and help offset any pain in our SPY puts. Okay, so this one is another way to get a heads up for what may be coming down the pipeline in equities. We have the QQQ, and we have Ethereum, a digital currency. And so they're super correlated and relatively similar price. So it does make it easy to overlay these. And again, they're extremely correlated. And I do believe that because of the small market cap in Bitcoin and Ethereum, that they will go down with the rest of the S&P 500 as they are not selling at a relative discount. Now, right now, they're both, as you can see, behaving very bullishly with the QE. But again, as the QE runs out, as the deflationary pressures become more obvious, as everyone becomes unemployed, small businesses have to close their doors and go bankrupt. And we have a transition from a change in consumer behavior that's going to put some businesses out of business and force other businesses to rethink their business model. That's really what's okay. Donald Dickey says, I missed it, but what's the strike? It's the $4 put option strike. Donald. Jack, go ahead and post your question about the SPY put. Yeah, Jack, I will issue the next trade alert to change our SPY puts as early as this Friday. Currently, I don't recommend any changes in your portfolio for that position. So I do want to confirm that they have slowed down the growth of their balance sheet based on their Friday announcement. And then I also want to see what their intentions are for the next week. So I potentially could delay this not from this Friday, but to the next Friday as well. So at the earliest, I would make a change this Friday, but most likely I'll wait one more Friday and get 2 more confirmations that they are putting an end to quantitative easing. Sure, Jack. So those put options are down, but they have a lot of time. And the 2008 crash, most of that crash was in 3 trading days. So we need 3 big down days potentially to get those back to profit. And we have a ton of time. So we got lots and lots of time on that front. So I will add to that position. I'm going to add one more strike at a different expiration, July, probably the 250. The rest will remain the same and increase relative risk. The earliest I would make that move is this Friday, but potentially I'll probably delay it to the Friday after that, because I do want to see the QE come to an end. And so it's been predictably slowing down week over week, reducing at about 33% per week. And if they continue that trend, that will really be all we need to tip this in our favor. Plus, we'll get through all the hype about reopening the economy, which is a complete disaster. And we'll see if anyone even does that. Okay, so crypto, highly correlated, a good leading indicator. the day we see crypto down 10, 20, 30% will probably be the heads up that the big boys are starting to pull the rug, and good timing for really understanding that we're probably at the top there. Okay, now we're looking at the TLT ETF. This is the monthly chart. Let's just look at some pretty obvious trends. 2008 crash, what did the TLT do? It went up. So if you know there is a massive loss hiding in the economy, that banks can't bail out single-handedly, that the government must bail out, that's going to cause a huge, huge increase in debt. The same thing happens throughout history, and that is a stock market crash. And you could argue that it's actually caused by the Fed cutting rates and making the investment into bonds too lucrative. So it really makes the bond investment risk-free, and you've seen it. You've seen your TLTs sit there and just trade nice and straight in the face of a massive stock market rally. So why is the bond market not going down when stocks are going up? That's what it's supposed to do. And that's because everybody knows what's happening. The smart money is the insiders are selling their stocks to corporate buybacks, and they're loading up on bonds and put options, just like we are, just like Jpmorgan is. And so this is really inevitable what comes next. So every time you get a big stock sell-off, TLT goes up. This happens every time there's a economic loss that private sector can't swallow, so the government has to do it. And again, if we got a 50% correction from $300 billion in bad real estate stateside in 2008, well, the magnitude of the losses this time around are no less than tenfold. I'd argue that it's potentially 100-fold worse. So they did something they've never done. They did rate cuts in QE back to back, and that was just to stabilize the markets and buy some time. But at the end of the day, my expectation is for the TLT to spike to potentially above 180 now, and that'll be a signal to sell our TLT call options and take profits on some of our put options. The put options I want to sell when that occurs, and so we're going to be looking at TLT above or near 180, VIX above 100, and that will be our cue to let go of these three puts. Potentially just these two at first. And then with volatility potentially above 100, which is what I think we may get in the near future, we start selling put options against these ETFs. And if it goes into the money, we allow it to be filled. So we get to keep the massive premium, which could be potentially 10 to 20% premium if we do the right strike. So the potential return selling puts on this will be very lucrative with a VIX elevated, again, probably close to 100. At the same time, we'll sell at least these two and quite likely hold on to these three. After it does look like it's starting to stabilize, we may sell this one. These two I do intend to hold into 2021 because I think we may get a fake rally into Christmas and then realize that we have to do more extreme lockdowns into 2021. Now, a lot of that does, again, depend on when we're getting close to either a vaccine or herd immunity. So timing of this will be nuanced. Okay, so TLT, despite the stock market rally, hasn't budged. That's really your giveaway that the bond market's correct. If the stock market rally caused a sell-off in bonds, then I would be thinking that there was a secret vaccine about to be rolled out next week and that we just didn't have the right information. But based on the information we do have, the bond market holding steady, stocks jumping 20% in a month, which is just absolutely crazy. And this not budging really is all you need to know. Okay, so that's your monthly chart. Also, the government has been growing its debt at an accelerating pace really since interest rates were jacked up by Paul Volcker, and Alan Greenspan came in and reversed all his good work. So bond market's in a big bubble, and it's going to get much bigger. I think TLT could go to at least 240, potentially above 300, depending on how low interest rates go. So we'll take a look at that in more detail. Here's a daily chart on TLT. And again, this sell-off right here was at the same time that stocks were selling off and central banks had to essentially sell treasuries to try to protect their equity positions. So Japan, Norway, a bunch of big funds. And then you could go down the chain. Ray Dalio, all the smaller hedge funds. By small, Ray Dalio is the biggest hedge fund in the world, but they're a tiny ant compared to a central bank. So TLT went right back to that 170 level, didn't last for long, and I anticipate it going much, much further, really until the growth of debt slows down. We can predict that this will go up. So if you think corporations are going to have earnings growth, buy stocks, and again, that's predicting that will happen in the future. If you can predict the government's debt will grow, you want to buy their bonds. And we can look at that mechanism. Okay, now we're looking at 30-minute charts. We did get a little sell-off Friday, which was a knee-jerk reaction to the Fed saying they're going to drop the QE purchases. But if you do look at history, QE, even though the Fed's buying the bonds, is bullish for stocks, and it's rate cuts that are bullish for the bond market. So if you have no QE and you keep rates at zero, it sets up a strategy for big banks to buy bonds where they cannot lose because they borrow for zero. They pick up the debt product for a positive yield. Then they go to the repo market if they want and get more cash. So it does allow them to aggressively grow the size of their balance sheet for free to get a risk-free return from the Treasury. And then if they believe yields are going lower, which again they've done for the last 40 years, then you can anticipate selling those at the bottom of a crash to the Fed for a big profit. And then they get to buy stocks. So that's really the big picture with the stock bond market. Okay, in this chart, we're comparing the SPY to the TLT. The SPY's in the candlestick black chart and the TLT's in the orange line below. And if we zoom out, you can see these two asset classes are constantly fighting over money. The bigger the bond market gets, the larger the valuation of the stock market gets. And so although in the short term they're fighting for money, in the long term as that TLT goes higher, it does give larger potential valuations in the stock market. So the good news is that after this crash does transpire and the debt has been raised and the money has flown from the Fed to the primary dealer to the government and then is reallocated into the economy, that the valuations of stocks are going to be significantly higher because of the increase in money supply. So the returns we can make buying these different ETFs after the big crash occurs are going to be once in a lifetime, just like the opportunity to short this market. So as far as how low it goes, I would anticipate it could break past the high of 2008, but I would be skeptical that it goes below the 2008 low. So I think the end point should be somewhere between that high and that low, unless nothing short of a miracle comes in and changes the predicament we're in. Also, the Fed buying stocks could do that, but they have to be careful about not devaluing the dollar too much. So they'll want to do that at the cheapest price possible to stabilize the market and create a floor, and not want to likely do that when it's worth $28 trillion because there's only $6 trillion in the whole balance sheet. So there's not enough dollars to let everybody out of stocks, unfortunately, and there never will be. Okay, in the next chart, we have the same comparison, but on a daily chart. And again, you can see the TLT is going up, even though stocks are going up. That just doesn't happen. We also saw a TLT go down with stocks. Again, that was the margin call. That usually does not happen. So I'd say you got another 4 weeks to wait, guys, before we get the next big tank at a minimum, or rather at the maximum, and that it could happen quite sooner. So really the key catalyst here for us will be the Fed reducing its balance sheet growth, which it's been doing at an aggressive pace for the last 3 weeks. So we've seen them drop their QE purchases by about 30% a week. And if they keep that up, we could be at a very low level within 2 to 4 weeks. And at the same time, the economic impact of all this will start to be showing up in all the data. So we've got data on our side. We've got people scared to go out and purchase. We got people scared to go out and work. In fact, we got people who just don't want to work because they get paid more to sit on their butt. So you have an increase in the cost of goods and you have a shock in demand. And that's how you get a Great Depression. So could we be too early to hope that there's a bottom this year? Absolutely. So do anticipate that when I do get us into a long position, it will be well thought out with downside married put protection in case this does go into 2021. So that is the outlook for that. Now we're looking at the 30-minute chart. And again, just the general idea is that TLT goes up, SPY goes down. As the TLT goes higher, that represents a growth of debt. To make that mechanism work, they have to grind interest rates lower, which allows banks to get a big profit from buying government debt. Now, in the short term, that makes capital magnetized to bonds. But in the long term, it does increase the total money supply and allows for greater valuations in the future, just not at the same time. So we've got to follow the money. The big money is going to be buying bonds. Otherwise, the government's not funded. We can't plug the holes in the economy, and the whole thing comes down. Okay, so this we're looking at 3 different yields for Treasury debt. We have the 30-year, the 10-year, and the 2-year. So again, we do want to see the 30-year have a healthy spread between the 10-year and the 2-year. We're playing the 30-year, and so it certainly does. The lower these go, the lower we can anticipate our 30-year Treasury goes. And again, the TLT benefits from cheaper yields and higher bond valuations. The bond's going to pay out the same. It's either a big fat yield and a smaller payout on the bond, or a low yield and a big bond. So we're expecting that the yields go lower, so the bond goes up. That's how you make money on the TLT. And this has been a pattern that's happened ever since Paul Volcker jacked up rates to over 15% at the federal fund rate. And then Alan Greenspan came in and started to reverse all those actions. So same for Bernanke, Janet, and now Powell. Same setup, just blowing up the debt at the government level, which again it's no coincidence that these big rich bankers end up having prime spots in the government as they are a team. Okay, well, let's compare it to other markets that we have to compete with. Who else wants to sell debt? Well, Germany, Japan, and China do represent your bigger markets, as well as, what else do we have in here? We have China, Japan, and Germany in these 3, as well as the US 30-year. So US 30 years, the candlestick, we have the Chinese yield way up here at 3.3. Now, our debt market is something like 20 times larger than China, so it's a small market. But you can see China's yields could crash significantly from here, so that's an interesting trade. But who's really having to raise the most capital, or who can raise the most capital? Well, again, an increase in debt is always correlated to a drop in interest rates. That's how they're able to make that work. And so you can see the US is aggressively printing money and raising capital. And so they're doing this at the expense of anyone who holds a US denominated product, whether it's a treasury, whether it's a stock, or whether it's just dollars, or even debt issued in dollars. So they can only get away with this for too long before all the lenders question the value of the dollar and start liquidating assets. Now, in the Japanese market in orange and the German yield in blue, this is really the 2 markets who've experienced or experimented with negative yielding debt. So imagine a 30-year German bond, you have to pay 3 cents a year per $1,000 to have the right to lend Germany money. So you really aren't hoping for anything other than the value of that bond to go up. So you're gonna have to pay them even more and more money to hold that bond, the lower that goes, in anticipation that, again, their economy is gonna crash. They're going to have to increase debt, and to do so, they have to benefit those big banks buying that debt. And they do that by letting yields go lower, and in turn, stocks crash. So lower the German yield goes, the better for our position in the TLT. I expect some pretty extreme, unorthodox moves in the bond market due to the gravity of the situation. That's a global problem. This is not localized in any single market. Really, the whole global economy is going to be stuck in this predicament for the next 2 years minimum. Again, if we go towards negative territory in the 30-year US Treasury product, then we're looking towards those $300 levels on the TLT. If we just go to 1% yield, that's your 180 on the TLT. If we get to 0.5% in the 30-year yield, then you're up towards that 240 level on the TLT. And if we want to break something like 320, then we'd want to see it hit the same yield the German Bund had just last year from the trade war issues. So really the key is to watch for the growth of the debt to slow down and for this entire quantity of debt to be sold, and not just sold at the front end of the Treasury. Really, the US wants to finance this debt on the long end. So as soon as we've seen that move completed, and we're starting to get hints that the Fed's going to come and vacuum those debts off, that'll be the signal to exit the TLT completely and to be long stocks. So that's what I see coming down the pipeline for debt products and who we have to compete with to raise money. So similar chart, but now we're on a daily schedule. So interesting, we are seeing yields spike at a faster rate on all the other products outside of the US product. So the US is taking advantage of its dollar supremacy right now and able to raise capital at a faster pace than anyone else. And it's at the cost of all their really loans to America in the form of any sort of investment that's correlated to the dollar. And this is the same chart on a 2-hour frame. We did pull off the German Bund just because its moves are so dramatic because of its negative rate of change that I did pull that out. But we can see the extreme correlation, and I do anticipate that China and Japan will have to push rates lower to raise more capital as their economy slows as well. Okay, here's a look at the China Large-Cap ETF. So we have FXI. If we look at the 2008 crash, it went from as high as 70 down to as low as 25. 2015 was the last time China nearly collapsed its market. And this is because they're just sitting there building massive amounts of real estate that no one was using. So cities the size of New York, at least a dozen that were never occupied, just left ghost cities, half built. Tens of millions of luxury condos were built that were never rented. And so there was the crash you saw in 2015, almost took down the world stock market. But then we came in with some more QE and rate cuts and really blew China's debt to GDP level, at least from their internal debt, not external. So they just loaned themselves their own money by devaluing their currency as their primary debt model, compared to the US, which likes to sell its debt externally. So if China wants to rip off anyone, they just rip off themselves. But if the US wants to rip off anyone, it does rip off all the foreign investors who've invested in US products when we print dollars like we just did. So they were able to get a 2-year bounce, and now you can see that just China in general is just really in bad shape. And so if we get the political chaos that might happen this year, I anticipate this could go back towards this 31 level or lower. However, if we get an extreme move and we outlaw US ETFs that funnel money into China because there's no auditing of their companies, then this could go to zero. So that's really the twofold. So hopefully they do outlaw it and you guys get that 30-to-1 return on this. Best case, okay case, we still get a 50% crash from here and then sell this around the same time we sell the rest of our puts. Now here's a product I found that's interesting. I haven't done a lot of research on it yet. It is CNYB, so it's a Chinese bond product. And if we do note that the Chinese 30-year is still at an elevated level, 3.3. And we do see over the course of time, it tends to catch up to US yields. This has a big move down as well. So I haven't placed any trades on that, but just brought this up as another way to bet down on the Chinese economy. Okay, gold copper ratio is Jeffrey Gundlach's favorite way of predicting short-term yields. And so again, at some point, I would like to sell our oil position for a copper position way before the rest of the crowd next year. So we're looking a year down the road. But copper is used for construction. And so the copper gold ratio has been very good short-term indicator for where yields are headed. And clearly copper's crashing and gold is either maintaining value or going up in value. So it's making this ratio go lower and lower, which does indicate slow growth in the economy. Also, any kind of oil price below 50 tells you the world's not growing, it's slowing down and contracting. So between the copper and gold ratio and the oil costs, it's quite clear that we are in a downturn, a recession, and potentially in a Great Depression. Okay, yield curve in another way to look at it from this website. Let's just look at the inverted yield curve to start the year. So we saw the yield curve invert in January, and it had been inverting the year prior as well. So the Fed does not like that. Signals recession, another heads up that we have a crash ahead. It's very rarely been wrong. Fed came in, cut rates to 0, did QE to straighten the yield curve out. The result of this has been to drag the 30-year yield down, down, down. So there's a lot of room for that 30-year yield to crash lower, which means TLT could potentially go up much higher. So all indicators really telling us the same story. Here's the federal funds rate for the past century almost. Can't quite get the full century on here. So what do we want to point out here? Well, the gray bars represent recessions. It's almost as if cutting rates to 0 caused the recession. That's not really the case. The Fed is very, very, very smart, and it's ran by the big banks who really control the world. They control all the governments. They put their people into powerful positions. So if you want to know who's really running things, it's the big banks. And so every single time they realize there's a boo-boo in the economy that a single bank can't pay for, they have to use the government to fix it. So they cut rates to 0. This allows the primary dealers to borrow for free. They have to buy the huge splurge of debt coming out, which on its own should make the exact opposite happen. Debt should cost more as you expand, but they know we wouldn't be able to afford that. Now, would we? So they cut rates to 0. They push massive debt through the Treasury. The big banks buy it up. Again, we've gone over this model over and over again, and it creates a balance that is much safer to buy debt and much less safe to buy equities. So again, we haven't even started to roll over the debt from the T-bills to the bonds, and we haven't even started fueling this $2.2 trillion plan. Now we have another probably $2 trillion coming down the pipeline for more small business loans plus infrastructure. If you keep businesses from operating and try to keep everybody employed, then that's going to add more and more money to the government's balance sheet. So government's debt is exploding at the fastest pace in history. That's extremely bullish for bonds, very bearish for stocks. And we can see they do the same thing every single time. So every single time they cut rates, banks buy the government debt. The debt fixes the problem. Stocks crash. Fed buys back the debt from the banks for a huge profit. The banks can then go buy up stocks half off. It's a great deal for banks, and it's a great deal for you if you understand how this all works. Yeah, Murray, we're going to hold that and sell it before May 15th. There probably is a copper ETF, Ross, but I like the copper miners. So there's 2 companies that we can buy that mine copper, which we actually had bought early on this year, expecting, again, the exact opposite. But once we saw China's stock market crashing when it should have been roaring higher, that was the key to do that. So yeah, I'll give you the right stock to buy for copper at the right time. But a good year out from that. And as you can note, I'm trying to typically buy these before I believe a bottom is in with the married put, so that we can be selling long before everyone else and getting past that year hold time. So we're going to use the put to get in early. If we do have more downside ahead, the put really covers that downside, and again lets us get that year clock started much earlier than the rest of the crowd, which also means we can buy assets before everyone because we're able to free up capital and realize less taxes. So this happens like clockwork. And the big thing that could get people off guard here is we go to 0 rates, which we're at. We print trillions of dollars, we're there. And then inflationary pressures come and force the Fed to hike rates, which would weaponize the dollar and be a great way to attack China. So there is a potential that we go into a period of interest rate hikes because of inflationary pressures, potentially 2 to 5 years down the road. And if that's the case, then we have to really change our strategy completely, because that will wreck stocks and bonds at the same time. They hate to do that, but we're at 0. They're going to have to get rates back up at some point. So that'll be an important period to play correctly. Here's your Fed's balance sheet. Again, they shot it up. That's why our puts have gone against us. We bought before they had done these massive expansions. And I do, again, believe they will taper that off and allow the bonds to appreciate and not to be flipped, which will be bearish for stocks, bullish for bonds. Okay, here's our debt. So far, they have not rotated the debt into the bond. So the T-bills have taken on all the new debt, and they've just bought that at the Fed's level. The Fed's actually buying twice as many treasuries as we're issuing. So we're allowing big banks to reallocate into cash from selling their treasuries, mostly big central banks. So they're trying to stabilize the stock market. But that's coming to an end. And I think the next big move is to rotate this debt out of the T-bills into long-term treasuries at the lowest rate possible, so the government doesn't have so much interest to pay over time. Here's an interesting yield curve movie. So just want to show you what happens during a healthy stock market. You can see yields are rising as we approach 2000. Okay, so healthy stock market, your TLT is going down, not up. TLT will never, ever go up during a healthy stock market rally. Okay, now we're getting towards the 2000 bubble, and watch what happens. Your yield curve is going to invert. It's almost inverted. Coming up, oh, there's your yield curve inversion. Okay, so yield curve inverted, that just means it's not going up. You get the middle part lower than the front end. And here comes your crash, and watch what's going to happen during the 2000 crash. These yields are going to plummet lower, which means, again, your TLT will be going up. And here we go. So watch those yields drop, especially on the long end. And there we go. Stocks are tanking, yields are going down, and you made a nice profit. Now we're rebounding back to a healthy yield curve. Okay, so I think we're probably getting towards the bottom of that stock crash here. And now we're going back into a new bull market towards 2008. You're going to see the same pattern replay. Again, I like to watch this. It's a 20-minute video if you watch the whole history. I've watched this probably 100 times. It's fascinating to watch. But you're going to see the same story play out. Healthy stock market, yields rise, TLT is going down, stocks are going up, economy is actually working. People want to buy stocks. They don't want to buy debt. But then what happens? We'll see that yield curve invert. And then we're going to see a stock crash and yields drop TLT goes up, and then we'll see the same thing has just happened again. Okay, so here comes your yield curve flat right here. We're still 2 years out from the crash. Okay, now the yield curve inverting does happen. Here's your yield curve inversion. It tends to happen about a year to 2 years ahead. So we did have yield curve invert last year, again this year. And so it's just a general warning sign that things are not operating properly. Here's that crash in 2008, and you saw the yields drop. Okay. Here comes the big crash right here. Boom, just gets whacked way lower. And then we come in with QE. That's good for stocks, bad for bonds. And this is where the banks are getting out for a big profit right now, and they're buying stocks up. And we're going to see the same cycle repeat itself right now into current. Now, this doesn't go all the way to the current date, unfortunately, but you'll get the picture here. Okay, so we're coming into a healthy stock market. Now, 2015, remember China almost crashed world markets from their misallocation of capital and primarily construction. There's trillions wasted. And it's still just totally wasted right now, rotting away. But during a healthy stock market, yields go up. Okay, now here comes your little sell-off in yields. 2015, China nearly crashed world economy. But they saved it by taking their GDP debt levels from something like 250 to 350%, which are not something you can keep up for much longer. So China is really in a heap of trouble. Now, 2016, we have a super healthy stock market till current, and yields rise, 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 rise. Now, remember the Christmas massacre. The catch is if yields rise too much in a overblown debt market, that will crash the markets in itself. You're going to see these yields drop sharply into the Christmas crash right here. Boom. Okay. And then we come into 2019 and begin reversing all those positions. Okay, so that's into that video. Try to get an updated one. So it just happens over and over and over again. All right, let's go to the next set of charts. Okay, we've covered this. Okay, so what's another key item? Inflation. So the Fed will hike rates if there's inflation. Right now, there's no inflation. Inflation's super low. So if you have globalization, cheap oil, and a third of your labor force laid off, you're not going to have inflationary pressures. You're just not going to have it. And that's really the reason you want to buy gold as well as Bitcoin. So the only argument to be buying up gold right now is that we're predicting inflationary pressures into the future well before they've occurred because of all the money printing. So again, I believe the money is going to flow to the bond market from the government's treasury. That's going to be just siphoning money out of all the other markets. That in itself can cause a stock crash. They have to reallocate that capital to plug all the holes in the cup in the ship, which there are many. After those holes are plugged and everybody's back to employed and oil has gone up, then with all the new money circulating in the system, we can expect some inflationary pressures. So with the deflationary pressures, I would expect anything that lives in the stock market to have downside pressures ahead. So USO and GDX, we've made an exception by owning put options to protect against that, as they have different arguments to be made. So inflationary pressures can be seen potentially a year to 2 years into the future. And we're seeing every country devalue their store of wealth. So that's really your argument for gold at this point in time. Oil, US oil is down 90%. That's a huge discount compared to 2015. And I do think the government will come in and bail out the oil companies. So That's why I've made an exception to buy those two early. Also, if we anticipate that copper may hit a bottom around the summer of next year, we want to be able to start taking some profits potentially off the oil position specifically and get it into the copper position. Although I do anticipate the gold will have to hold for potentially longer. Okay, so inflationary pressures are low, but there are periods of time where you get out of control inflation for long periods of time. So I want to point out from 1965 through 1981, we had a bear market in stocks and bonds because of high levels of inflation, and Paul Volcker had to hike the federal funds rate up to above 15%. That I do think is in all of our lifetimes and will be a market we have to play carefully, which is essentially to short everything under the sun. So first they got to fix the economy. They're going to overlook inflation, and we're a long ways from that period. So keep an eye on that. That's a key. Okay, so now in the next chart, we're looking at the S&P 500 relative to Brent oil. And so we can see quite a correlation here. Strong oil prices represents a strong economy and growth. Weak oil represents a weak economy. And again, I do believe that that in itself is a very good heads up beyond every other writing on the wall that we have a massive stock market crash ahead. So weak oil prices really is what kicked this off, this huge drop in oil from here to start off the crash in March. Okay, in this we're comparing oil to bonds. Now the exact opposite, weak oil means strong bonds, and really there's really no hope in the short term for oil, at least spot oil, to really get back to that 50 level and maintain it. First, we have to work off all the surpluses that are building up worldwide, and then get capacity and production back up. So again, another indicator that you do want to be long bonds right now. And government bonds, not corporate bonds, to be clear. Okay, in this we're comparing WTI versus Brent. So it's really the US price compared to the Middle East price. Is just a oversimplification. And you can see the US price has oversold itself relative to the Middle East market. Another reason I wanted to hop onto that position today. Here's just a look at Brent oil on its own. So really, to believe we're in a healthy economy, we want to work those surpluses down, get the output back to where it was in 2019, and push above 50. So that'll probably be quite a day. Until then, many oil companies quite likely go out of business, and including and especially U.S. oil companies. So they're probably at the verge of many bankruptcies and the U.S. bailing out that sector, as it's critical that we have energy independence. So that's why I like that U.S. oil play today early. Okay, that's the weekly chart. Let's go. Okay, now we're comparing in this chart natural gas UNG, so United States natural gas companies relative to U.S. oil. And if we do zoom in, we can see that relatively USO is a better bargain today. And I don't see us actually buying UNG. I like U.S. oil for the same correlated trade at the best price, with the most highly likelihood that we see the government come in, just put a bottom on that, potentially in the very near future. Okay, so same chart, just different time zones. And the key here is that relatively USO has sold off at a faster pace than natural gas. Okay, now we're looking at gold. So from this picture, we can see oil is getting near the high of 2012, which was caused by about $3.5 trillion being printed from 2009 to 2012. And then that's when they started doing Operation Twist and took a pause in QE. Then in 2015, we started going back into things that were closer to QE as China almost crashed. And so we got the next big rebound. So the big question is gold going to break into new highs and remove its correlation to stocks because of the massive money printing and ignore the year of deflation? Or is it going to have a sell-off with the is it going to have a sell-off with stocks? Now I do have a quick question from Trevor. Please briefly mention how the U.S. can raise USO to bail out oil companies. Yeah, so the government's going to ensure that our U.S. oil companies, at least the big ones, remain in business because it's quite clear that the big trend right now is to bring home everything so you're not reliant on global partners, which we're learning quite abruptly can be dangerous, especially with someone who wants to take you out, which is China. So yeah, my anticipation is gold will sell off and we'll have a better price to get into gold. Let's take a look at that. But again, we're doing some pretty abnormal things right now, rate cuts and QE at the same time. I'm betting that the QE stops so that the government can fund its debts and incentivize investments into bonds. So here's a look at gold on the weekly chart. Soon we're going to be comparing it to TLT. Here's a look at gold on the daily chart. So it's really at an extreme price. And again, my expectation is the central banks are going to punish everyone trying to buy gold by selling some of their huge stash, shorting it, and then buying it all back up. Now, I do believe it won't go as low as it had previously, as this is anybody who can see at least a year down the road can understand that gold's going to have a greater valuation in the long run. Okay, so let's look at, here's your 4-hour chart. And okay, now we're comparing it to the Dow. So this can go back to 1998. And so we can see gold has kicked butt in the long run. But during the 2008 crash, you can see in the very start of the crash, gold had a spike. But as the crash really turned into a systematic financial crisis, gold did pull back considerably. And then once QE came in, that's when gold really rallied hard. So we got to ask ourselves, is this the end of the crash in stocks and QE will go indefinitely until this whole problem has been fixed? Or are they going to end QE again because they want to fund the government and they have to incentivize bond investment? So they have to stop QE. So if they stop QE, almost certainly gold will sell off with stocks. So that is my prediction for gold relative to the stock market. Here's that look on a weekly chart. And so SPY was outperforming gold during the early Trump days. But as of recently, gold's been outperforming as the knee-jerk reaction to the sell-off rebound. So will they both sell off together? I believe yes, but you've got a lot of big players who, okay, if you can't get filled at that strike, Karen, I would just do some different expiration dates and some different strikes around the 4, just so that you have every single share protected with a put is really what's critical here. Okay, so again, we've got a lot of big players saying that you cannot hedge with the VIX. You can't hedge with puts because they're expensive. The best hedge now is gold. Problem is the central banks know that people want to buy gold. It doesn't help their their agenda, and their agenda is to fuel the government and to obviously make money from fueling the government. So they want the money to flow into bonds, not gold. They can easily sell some of their gold reserves and create volatility. So you get a bunch of momentum players thinking is going to break out, just who look at charts, and it's a beautiful chart. Looks like it could break into new highs, and I think those people are going to be punished. Is there a chance we're wrong and that there's enough QE at different central banks to keep this rolling higher? There is. So that's really the risk of gold at this point. Okay, so here's your SPY, and you can just see that huge correlation to the SPY and gold. This is on a 4-hour chart, and again, even on a 4-hour chart, you can see they're extremely correlated. Okay, now we're looking at gold. We're comparing apples to apples instead of apples to oranges. So both were fruits, I guess, in the last example. These are just going to be different flavors of your apple. So we've got gold in the candlestick. We've got the GDX gold miners in the orange, and then we have silver in gray. So again, they're all extremely correlated. What makes the most sense and what's the best opportunity? So I'm going to go back to the 2008 crisis for some what we're expecting, which is, again, a financial crisis. Check mark. We've definitely got that. Rate cuts, we've definitely got that, same as 2008. QE, well, they came in with QE a bit early. The big question is, are they going to continue QE, or are they going to cut it off and then re-presume it after another market crash? So we did see they waited till the market crashed to start doing massive QE, and I think they'll do the same thing. So I do believe they're going to taper off the QE purchases, allow markets to crash, and then resume QE, which is what they've done in every other crisis, because it allows them to fix a problem and make a lot of money doing so. So in this chart, we can see that during the stock market crash 2008, gold went down the least, gold miners went down the most, spot silver went down less than gold miners. But once we did get a bottom, the asset that outperformed by a margin of 50% relative to 100% was gold miners. So this time around, I do believe gold miners will once again, and in fact, the better gold does, the better gold miners will perform and outperform. So we can see kind of the 1-2 punches. You get your market crash, you rotate from rate cuts to quantitative easing after the money's been raised for the government. We haven't raised the money yet. That's what's really critical. We have not raised the money yet. We've printed money, but we have not dished it off to banks and especially to foreigners, which is where we want to store our debt, not internally. So GDX, I do believe, will outperform gold, and that after gold is getting towards a new, really breaking out into new highs, after gold miners has outperformed spot gold for a considerable amount of time, we can look for the return on spot silver to catch up to gold miners, and look for a transition to catch a huge rise in spot silver. So you can see spot silver rose 400% from the bottom of 2008 and was really the best play. But it was just a short multi-month run up where that occurred. So I'll be paying close attention to the relationship between gold miners and silver to try to capture the most profit out of this perceived move ahead for precious metals. And again, because we're getting in early, perhaps, relative to this crisis, we might be buying gold miners something like right here, selling our put down here for a profit on the put, and then potentially adding more risk and then catching the next big move up. So that's what I see coming down the pipeline for gold. As far as how they're performing in the short term, well, if I zoom in on this, you can see that the gold miners in the recent rally have greatly outperformed spot gold. And so we're seeing that correlation still works. A 60% run up in GDX relative to just a 10% run up in spot. So gold miners has the opportunity for us. And if we get that buy and hold in early, we'll be able to rotate some of that into silver and get the low tax rate much sooner than other investors who are waiting for the absolute bottom. So again, if you waited another 6 months to buy GDX, your ability to sell your shares, if you're a smart investor who understands tax obligations, you're going to have a 6-month hold longer than our investors will. So our investors will be able to get out and rotate into silver early, whereas others could, but they're going to have to pay twice the tax obligation. Okay, now we're looking at the dollar. Strong dollar represents problems in emerging markets, and people will end up selling their stocks or their bonds to fuel their dollar needs. They operate their economy in dollar. So the last big crash, we saw a dollar spike, and I expect to see the dollar spike once again, especially as the QE runs up, which is going to stop this liquidity that's keeping the market, keeping everything up. So we're really seeing just everything stay floating up in nowhere land, which makes it hard to understand what's a good trade that makes sense and what's a bad investment. So when there's 125 to $600 billion being added to the liquidity pool, it makes it almost impossible to understand what's a smart investment, what's not. And that's why we see the TLT staying strong when it should be crashing if the stock market's going up 20%. Okay, now we're looking at different currencies denominated against the dollar. So we have the euro, the Aussie, the pound, the Chinese yuan, and the Japanese yen. And the Chinese currency is actually showing a little strength and stability relative to the dollar in this short-term move. But in general, we're seeing, even though we have the strengthening right after all this QE, let me zoom out a little bit. We saw a little bit of strengthening when the dollar hit that 103 on the DXY, but now it's starting to lose strength again. So the more we pull off QE, I would anticipate that other central banks will keep doing a little QE, and that'll cause the dollar to sharply rise. So the end of QE is really critical for what we have coming down the pipeline here. Okay, let's go to the next set of charts. Let me close that out. And I am going to be working on one more set of economic indicators that's highly similar to Jeffrey Gundlach's quarterly presentation. I love his information, so I hope to have that done as soon as possible. So there'll be one more big set of charts we'll look at on a daily, which looks at things like unemployment, GDP, forecasts, sentiment, all that great stuff. But it's all correlating towards terrible times ahead as well. So hopefully get that built in the next, possibly by the end of this week. Okay, so let's look at the news. We'll start off with the tweets I've retweeted. And again, if you do want to see what I'm retweeting, you can follow Generates Income. So, okay, we have Larry Kudlow has asked how long a second round of PPP small business aid will last if Congress approves it this week. He answered there's no good estimate. I think something like 2.5% of the small businesses in America were able to get funding. So, and that was something like 300 billion that was let loose. So that's just getting started. And their mindset is that we're either going to have to pay unemployment or we can just pay them to sit on their hands. And that way, when these businesses do open up, well, all the employees will be ready to go back to work. The problem is a lot of these businesses won't ever reopen back up. And if they do, they're going to fail. So it was good to cause a little pause and a jump in the markets and give people a little relief. But again, we're just diluting the dollar. We're not creating any economic output. So stimulus is really not going to help anything except expand the debt market. So all the stimulus in the world, it would not change our trading plan. The only thing that goes against us really is quantitative easing, and that has its limitations. If they do too much of that, you'll end up with the same result where people lose faith in the dollar, dump assets correlated to it, or they start devaluing their currency, which in turn the US would probably dump our Forex reserves So no matter how you shake it, this is really going to end up in the same place. Okay, continuing on. New York Fed accepts 350 million in bids on the overnight repo. This has been at zero because everybody's just been cashing out their bonds and fixing up their balance sheet for the next big move, which again, I believe will be buying up massive, massive treasuries. As we slowly remove QE, I'd expect the repo to get back into full use. They've essentially said they'll do unlimited QE. So what's repo? Repo is really good for the government to sell debt. It means that the primary dealer borrows from their Fed for free, goes in and buys the debt that they have to buy for a profit with the yield, and then they can put the debt back to the Fed and get cash. So it allows them to expand their balance sheet, the size of it, as the government expands its debt issuance. It forces them to buy and hold these treasuries instead of just selling it for a guaranteed profit right now. So if you realize these guys have been buying these debts for decades, they've got a lot they can sell off for QE for a huge profit today. So they're taking full advantage of that while the QE is available. But the QE is coming to an end. So that's really why I expect the repo to start showing use in the foreseeable future, which again is really good for treasuries. It does help get some liquidity into to the broker dealers so they could buy stocks. But what it's not allowing people to do is to dump their treasury position. And so it's forcing everyone to hold these positions, which is what we want to see. And again, the timeline to sell all this debt is no less than a couple of years because of how massive the deficit's going to be. Okay, biggest U.S. junk bond ETF saw a record 2.3 billion in inflow last week as the Fed is buying fallen angels. So not all junk bond debt, but some. Okay, this guy's a jokester, but he's pretty funny. Why don't they store all the oil at all the empty WeWork offices? So WeWork was already in trouble last year. Now I can't, SoftBank is one of the big, and Goldman Sachs and Jpmorgan, a bunch of big banks are trying to pump it and dump that. Really, it's just a massive real estate company. So they're in some serious trouble. Funny joke. Okay, so Robinhood users, a bunch of young folks have been massively loading into this position as it's tanked. I bet you that they are sitting on some very, very large losses, and we come in potentially more downside for us, but potentially government bails that out. Ross says, why not sell off all the U.S. platinum to pay off the debt? Funny. Okay, so just had a long chat with a friend who's a small business owner and entrepreneur for startups. This economic situation is absolutely devastating. And guess what? Even though his company qualifies for a small business loan, he missed payroll last week because the government ran out of money. Okay, here's your Chinese propaganda. We like to see what they're teasing us about now. Countries or regions lifting lockdowns before the conditions allow it will pay the price of epidemic rebounding. President urges early lifting of stay-at-home order. It will become new evidence of his inept governance in 2 or 3 months. Viruses like leaders like him the most. Yeah, it's just a tough situation. But what he really did was put the responsibility on the governors. So, Hu Jiheen, I advocate that governments of all countries or cities where the death rate per 100,000 exceeding 10 should apologize to its people, since the ruling government should take responsibility. Hopefully the international community sets a time to apologize simultaneously. Please retweet for support. So they're saying they only lost 3,000 or 4,000 in China, which we all know is probably a magnitude of 100 times less than the reality. Jeffrey Gunlack, WTI futures are down 18% right now. That's a lot, which again, we jumped on with USO. Josh Crum, we've now passed 100 barrels of oil per ounce of gold. Typically, this tops out at 30 in a long-term range of 10 to 20. 30 is an extreme. Even in the 1930s, we topped out in the 30 range. So this just gives you an idea of how devastating the economy is facing in terms of lower growth for the foreseeable future. Small Business Association gave 1.66 million loans through the Paycheck Protection Program, PPP, but there are 30 million businesses, so 5% have funding. Stephen Henrich, the economy is not fragile because of the virus. The virus exposed the fragility of the economy. 2009 through 2019 produced the slowest recovery in history while requiring the highest debt expansion and lowest rates in history. Now policymakers are doubling down on the same. So again, a lot of people don't want to believe we could go to negative rates on the US government products, that it would make the bond market not work, all the hedges not work. I do believe we will go there because otherwise they don't fund this debt and they don't have a chance at fixing the problem. So that's really not a choice. Now, will the consequences be long lasting? Probably create a decade of inflation like the 1970s, probably. But I do think we're a ways out from having to deal with that concern at this point because unemployment is skyrocketing, oil's cheap, so inflationary pressures are not a top concern currently. This is a massively complicated subject, and unfortunately, our political divisions and structures are not conducive to even begin that difficult and adult conversation that we frankly need as a country and as a planet for that matter. Food Lines in Texas a week ago should say something about the severity of the economic loss. Okay, for you guys in the Hong Kong trade, I do need to do a little more research on what exactly Article 23 is. Listen to a great interview, which I'll provide tomorrow for the boot camp fellows. Kathy C, I have that in the gold miner. So I have much more in the gold, in the commodities tab than I do cash available. So it'll look like it's 100% leveraged in there, but I realize I have cash available in my equity position. So yeah, it's in the commodities tab, Kathy. Hong Kong is suffering an Article 23 bomb thrown by the CCP, which will end the one country, two systems. So all freedoms are coming to an end. Time to involve the Hong Kong Policy Act of 1992 and remove the czar status. So again, this is exactly what we want. Chaos, turmoil, crashing GDP, real estate market crashing, and then throw in some US sanctions against Hong Kong. We start pulling out all of our people who live there, and it's the perfect recipe for the Hong Kong dollar becoming non-existent. So that's how you get the 100-to-1 return. And again, I'll cover this more on the Tuesday content, a great hour-and-a-half piece that really, actually the guy helped write the basic law of Hong Kong, goes through what's happened for the last several decades with this, but very good news for you guys with your Hong Kong short position. Just like I was right on ventilators, our country is now the king of ventilators. Other countries are calling, asking for help. We will. I am right on testing. Governors must be able to step up and get the job done. We will be with you all the way. So people don't seem to realize that the lockdown caused a slow of growth, but if you remove the lockdown, it's going to come raging right back. Gordon Chang, correspondent Michael Yan, tells me that after speaking to a journalist source, he thinks China is about to go full Tibet on Hong Kong. Karen's having a hard time getting her puts filled. Well, maybe Karen, call up the broker and ask them to help you get filled. That might help you out. And again, you can do a little batches. So maybe fill a few batches at a time, and you can just change the expiration date. I would be doing market orders, not limit orders as well. But there's certainly enough liquidity to get your puts into place. The US does not have a bottom line for COVID-19 deaths. You only got one. So you did a market order, Karen? Is anyone else having trouble getting their put options filled? Let me know if you did or did not get your put options filled in the chat, just out of curiosity. Okay, Ron got his filled. Mark got his filled. Filled. Okay, good. So I think you can get it done, Karen. I am quite certain you can. Let's give her a few more minutes and we'll come back. Kathy got hers filled at $1.05. Gary filled. Okay, good. So I think you'll get it filled. Okay, Hu Jiheen, the US does not have a bottom line for deaths. Bringing the pandemic under control is not a mandatory task for the president and governors. They care more about polishing their image, shifting blame. So yeah, it's just a really difficult thing. You can shut down the economy and you end up with suicide, unemployment, and starvation, or you open the economy and all of a sudden your hospital system's overran. So they're going to have to be toggling back and forth no matter how you dice it. Again, the economy is going to have to go at a slow pace relative to last year. Neiman Marcus to file for bankruptcy as soon as this week. Stephen Henrik says it begins. Okay, Kai Cooper Schmidt. I hope I'm wrong, but just anecdotally, from walking around in Berlin today, I find it hard to believe we are at a reproduction R naught of 1. Seems to me, even before any significant easing of the restrictions, people are behaving more normal again. So again, people took the messages from the administration last week to heart and are starting to drop their precaution. And the problem is we're nowhere near the end of this. So they get a little bit of a flattening of a curve and realize what caused that flattening of the curve. And again, if we're not careful, this will come rocketing right back at us faster than before, which seems to be what's going to happen. Now, enough pain, enough death, and I bet you we see the entire world once again go to a lockdown. Okay, the real Kiyosaki, rich dad, poor dad fellow. And again, I do think these guys are early. If you have the right play with the put, it makes sense. If you have the gold miner, silver rotation strategy in mind and trying to be basically 6 to 12 months ahead of the curve on these, then our strategy makes a lot of sense. He might be setting people up for a disaster here who don't understand what's coming with the deflationary forces in the near term. So, but okay, here's what he has to say. Silver, the best insurance against the death of the dollar. Love gold and Bitcoin as protection against the now totally corrupt Fed and Treasury. Silver affordable to everyone. Silver industry metal will increase in price as economy recovers and demand increases for e-cars, tech, and medicine. Money is corrupt. So again, I think silver is going to be a huge winner at the right time, but he's quite early. Oh yeah, so Ross, we just want to know what the Chinese are up to so we can get an idea if we're going to go to war with them. If you know, I anticipate war with China. And yeah, well, yeah, we that's why we're short everything China possible right now. Okay, Q1 earnings growth, Q2 will be worse. SPX is reporting a decline in earnings of negative 14% for Q1, which would be the largest earnings decline reported by the index since Q3 2009. Okay, and this is just the start of the trouble. Hong Kong government amended a statement twice within a day, initially saying liaison office needs to obey the Article 22 of the Basic Law. The wording was later on removed and finally stated Article 22 does not apply to the office. Such move implies the one country, two systems is dead. So there goes your Hong Kong exchange. And there goes their dollar, their Hong Kong dollar. Jeffrey Gunlack doing some rough math. It looks like the combined value of the stock market gains off the recent low is roughly equivalent to the combined actual plus announced increases in the national debt. Yep. So if we expect that QE to come to a grinding halt, to fund the government, then that's really the best. Here's the fellow that I'm going to give you an interview for Tuesday if you're in the boot camp, who helped write the basic law for Hong Kong. Great interview. I feel, actually, this might be the newspaper fellow. Let me see. I feel relieved after months of witnessing youths being arrested and prosecuted while I stayed out of it. I actually felt guilty. I have been eventually prosecuted and have no regrets. I feel proud to walk the road of democracy. Statesman Martin Lee. The U.S. budget deficit is expected to hit a whopping 19% of GDP this year. So if you're looking for a growth of debt to be bullish bonds, you have the biggest growth forecasted in all of history this year. Yeah, let's see. I didn't actually hear this. Let's see if I got the audio on my thing to share.
Models are out of control. The economy is out of control. China is the one that's out of control. We're not going to let you destroy this country or our way of life. We've worked too hard and we fought too long to lose it to a Wuhan. That's what I said, a Wuhan virus that China knew about, openly lied about, said it couldn't be transmitted from human to human, and intentionally protected Chinese citizens from the virus, but allowed that virus to be released, putting the rest of the world at risk. You want to control people? You politicians want to flex your muscles? Well, start working on how you're going to punish, ostracize, alienate, and financially sanction and make China accountable for what they did to us and the rest of the world. But keep your damn hands off us and do something about what got us into this mess in the first place.
Love it. I think that's going to be the general tone this year. So mainland Chinese investors are selling Hong Kong property after China reports first GDP contraction in 4 decades. Now, Hong Kong's been crashing for quite some time. It's the most overvalued real estate, the most expensive in the world. And China's slowly moving their financial center out of Hong Kong into Shanghai. The communist propaganda. President Trump couldn't understand why China's death toll is much lower than the US. It's because Chinese government has adopted scientific and effective control measures. Loose political system of the US allows more than 4,000 people to die of the pandemic every day. Americans are so well-tempered. They claim only 4,000 died in China. I think that's 100-fold less than the actual case. Charlie Kirk, in January, the WHO tweeted that China found no evidence of human-to-human transmission of COVID-19. This was a Chinese Communist Party lie. Now Nancy Pelosi says it's illegal for Trump to halt their funding. Why are Democrats siding with the WHO? This is your daily reminder that JB flew his son to China on Air Force Two to help him secure $1.5 billion with the CCP. And Biden still sits on the board of a Chinese private equity firm, despite promising to step down. So I do believe this will be the headline for the November election here. So everything's really lining up for the FXI puts as well as the Hong Kong trade. More than anything, the choice of the people Beijing had arrested betrays yet again its total lack of intelligence on the Hong Kong democratic move. They're generally moderate, retired from the frontline politics. Importantly, none have had a real, let alone organizing role in the protests. Martin Lee bailed out after being arrested, a big media tycoon in Hong Kong who's pro-democratic. A lot of the leaders of the protests were also arrested this weekend. So that's the big headline coming out of that. At least 14 from Hong Kong opposition camps arrested over unlawful protests. Police are also searching for media tycoon Jimmy Lai. There seems to be a building expectations for a vaccine or treatment to arrive shortly for a virus that appears to be continuing to surprise with its effectiveness, adaptiveness, infectiousness, and persistence. How can you have a vaccine for something you have yet to fully understand? So the 2003 SARS virus, which this is SARS-2, so it's highly similar. They couldn't create a vaccine 17 years. HIV, 25 million plus deaths, no vaccine. So is there the money available then for that compared to this? No, so there's more incentive. Is there plenty of reason to think Bill Gates already knew the solution to this before it occurred? Sure. So I think that we do get a vaccine next year and that the people involved in it make trillions of dollars from this. So, but if we don't, we have to be ready that this could last even longer than anticipated. So very critical for timing. Illinois Senate president asked for $40 billion to help the pension system bail out nation. It's almost as if the entire system is broke and can't function without artificial liquidity injections. Okay, I think that's enough of the news for today. We've gone for 3 hours, so I'm gonna go ahead and I'll just show some headlines from a few other news stations. So see what we got at the top of zero. Rabobank, game over. Fed's only choice, exacerbate the wealth gap or else. See over at the Drudge. Okay, they've moved the headline. The headline just this morning was Vegas wants to reopen, which would be a disaster mid-May. Now they're showing oil price lowest in history. Could it go a little bit lower? Yeah, but right now it's at such a discount, especially USO. That's why I wanted to jump on that. Bloomberg, same headline, oil plunges below zero. We do know Bloomberg has a lot of money tied into China. So I do like to really, the two sources I really like to read the most are Bloomberg and Zero Hedge. I like to look at Drudge. They do get some different variety of articles in there. And then I'll really just look at the rest for headlines, front page headlines, CNN, CNBC, the Washington Post, obviously owned by Amazon, and then Fox for another look. Okay, guys, we've gone for 3 hours. Let's pull up the trade doc, do some last questions, and then we'll get ready to let you guys go and prepare for next webinar Wednesday. And Tuesday we have boot camp educational content coming out. So you have 5 videos to watch, which are pertinent to our current situation. And then I'm also going to be working on a tutorial video for the new spreadsheet so that we can get your spreadsheet linked to in every update, plus have a link to a simple tutorial with a cheat guide. That's my big goal for tomorrow, alongside just a general update for everybody. Okay, let's see who all we have still alive. Kept the majority of the crowd. We can go ahead and take some audios. Let's go ahead and open up the mic for Mark B and Wani. Mark, how's it going? Gary says, have you seen the latest Ray Dalio with Bloomberg? Yes, I have. In fact, I'm probably guilty of stealing some of his quotes in today's presentation, if you caught on to that. Now, he's one of the gold pumpers right now. Looks like he's pretty much just set to short the market and buy gold from what I got out of that. He was skeptical of bonds, which I think he's off on. Ron says, thanks for the spreadsheet tutorial coming out. Let's go ahead and Mark or Gary. Go ahead, Gary.
Yeah, I had a question because I watched it a couple times last night, and Ray Dalio's real down on government bonds. He says, why would you want to buy a government bond that's supported by a fiat currency, no matter what government? And he's talking about buying junk bonds and corporate bonds, saying that a lot of these companies are being rated as junk now that really aren't. He says, so the Fed's going to be looking at this and saying, well, what's in the best interest of saving the economy? Buying these junk bonds that really aren't? I mean, I just wanted to clarify it with you because I was kind of confused, especially when he was talking about bonds. He says, why would anybody in their right mind want to buy government bonds?
Well, you
Treasury
know,
bonds?
Stanley Druckenmiller told you to sell bonds in December and to buy stocks, and that absolutely was a horrible recommendation. He's probably the best, highest returning hedge fund manager of all history. Then
Well,
Ray
that's what he's
Dalio,
kind of saying too. Ray's saying that too. He's saying, buying stock. He says, I'd rather buy a stock that I know has a good return. And,
yeah.
I don't know. He just kept going on and on and on. Like I'm thinking, holy mackerel, because you mentioned his name all the time. So anyways, I just wanted to hear your viewpoint of it.
Yeah, so my take was that he thinks we have a stock crash that could last for a considerable amount of time. So he's just trying to short the market and then buy companies towards the bottom. And then looks like he's trying to build a gold position. But you got to realize he also has a different set of people he has to report to. Namely, he has a huge amount of capital from China, and he's stuck holding all these long equity positions. So, but yeah, no, I think quite clearly bond market's going to go up dramatically here.
What the other question I had was about the USO position
Okay.
you put on today. What is your thought behind that? I mean, these are U.S. oil companies that are basically bankrupt. And I know the government, you're talking about bailing them out, but I mean, the money goes so far. I mean, you're going to bail out the general public, Main Street, or you're going to bail out these domestic oil companies, shale.
Yeah, we have to remain energy independent. So without question, they will bail out the big oil companies. So we've already seen it. It's sold off 90%. So we're just getting greedy trying to time it any better than that.
Okay. Like I said, I just question whether these companies are going to be bankrupt and then not go open back up again. I mean, just because they can't. So, I mean, it's a matter, it's going to be some, pretty quick timing because they've been in trouble for years. I mean, in my opinion,
so let's keep it to questions, not comments. Okay, guys. So, yeah, we bought it because it's 90% sold off. Government's going to bail them out, and we have a put option to protect us through January 15th.
Okay. Thanks.
Very good. Yeah, I just don't want to have people throwing out random comments and kind of confusing the crowd. So if you have a question, just purpose it as a question. What we don't want to do is start to throw out lots of different opinions and confuse everybody. But yeah, no, I think we fairly covered the position of oil and how it has downside risk ahead, which is protected with our put.
Okay, thanks.
Very good. Okay, Mark B says, sorry, Mike's not working. Question in regards to our FXI and Hong Kong position, if the entities get delisted, do we instantly become a short-term capital gain or we hold it? Yeah, it'll be closed out right there. So we'll have the short-term gain on those, unfortunately. Jeff says, great job today. Thanks, Jeff. And yeah, guys, I do anticipate the potential risk of more downside on USO. And that's why you have your put. So we're well aware of the risk. So you can't lose more than 2.5% between now and January. Essentially, the most you lose is the cost of the put because it's in the money. So you're risking approximately 20% of 12%. So about 2.4% maximum risk on that whole position relative to it potentially doubling, tripling as oil prices go back up. But yeah, good good reasons to be concerned, Gary, but absolutely, without question, the oil industry will absolutely be bailed out. And because it's at 90% discount, I think it's time to hit that opportunity today. And will some smaller oil companies go out of business? Sure, but that's why we have the ETF. So we have all of them, and probably they'll just get gobbled up by the bigger ones. And that's really the big trend we're seeing in this crash, is all the big companies are gobbling up all the smaller competitors. Yeah, so the Hong Kong trade and the FXI trade are not designed. Now the Hong Kong trade we could hold for a year. Now that's a Forex trade, so I think the tax code on that's a little different anyway. So I'll double check on that, but I think we may actually have better tax consequences on the futures and the Forex trades relative to the stock, bond, options. I'll have to double check that. Ross says, last question, what is the most a person can lose on the Hong Kong trade just investing 1,500? You're going to lose the money maximum that's in there. But realistically, you're more likely to lose 19 cents a day from the swap cost as a real risk, because I think it's unlikely that they'll strengthen the Hong Kong dollar against the US dollar, because that would just it would cause everybody to sell the Hong Kong dollar, and they'd run out of cash. Trevor loves USO, and he is buying call options on top of the position. Yeah, so I mean, if USO just goes up from here, all I have to do is pay off $1, and then the rest is profit. So I just have to pay off that put. And so yeah, I mean, this was just at 13 in January. It was at, I'd have to double, either 30 or 40 in 2015. Mark says Kyle Bass did a fantastic interview recently on Thought Leaders. I saw that, I haven't watched it yet. Ross says with 10 times margin. Yeah, so it's gonna cost us 19 cents a day to hold the position, Ross. And so that's really the big risk. But I would rewatch all the modules on Hong Kong, because I go into great detail on really the history of that, what its purpose is, why, they have they're trying to use their central bank policy to mimic the US, but their economy is tied to China. And so that creates a really big problem for their financial system in general. Plus, there's 1.4 trillion Hong Kong dollars, at least times 7. So there's, in US dollars, there's 1.4 trillion, but their reserve is only $400 billion. So if everybody tried to convert the Hong Kong dollar to the US dollar at the exchange rate, they just would run out of cash quite quickly. So then what do? Do they borrow from China? Well, China is down to 3 trillion from 4 trillion in their reserve. So that would eat up a third of their reserve to potentially bail out the deficit they have from the reserve to the total amount of currency they printed. So Hong Kong's in some trouble. Yeah, so Ross, that trade's really safe, and the most you can lose, even if the trade did go against you, which again, it's extremely unlikely that would go against us outside of the swap cost. But if it did, it would only be the margin you put in, not anything greater than that, because they'll close out your position before you've used all your margin. So they'll just automatically do the margin call and exit that. Thank you, Mike. See you Wednesday, bud. Anybody else want to unmute their mic or post a question? Karen, did you get your puts? Okay, still working on it. Okay, Ross says, hey, I couldn't get the link for the case against China, said it was unavailable on YouTube. Oh no, that was the one with the philosopher fellow, right? See if I can find that link real quick. It was really good. And in fact, I'd say it's the best I've seen yet. Really just doing the whole timeline and how outrageous this is. He looks at it from a legal standpoint. It's odd that I took it off though.
I just posted it.
Oh, okay, great. So here's
Chinese Communist.
the fellow. He did another, you know, he's the guy who interviews this weekend. The guy who wrote the basic law for Hong Kong. Stefan. So he's relatively new. I do believe I had seen him doing some Wim Hof stuff a long time ago. So he thinks of himself as a philosopher more than anything else, less so financial. So I haven't watched a number of his videos, but the case against China that we just posted in the chat's excellent. And this weekend, here we go. This will be one of our Tuesday boot camp videos to watch.
Hi everybody, Stefan Molyneux from Freedom Main. I am here with Mr. Martin Lee, Senior Counsel, who was key in implementing what is effectively Hong Kong's constitution, the basic law. Thank you for taking the time today.
So that's a great interview that did come out just yesterday. Scott says, great call, Jason. You're the first to explain the negative interest rates for bond appreciation. Germany, yep. Very welcome, Scotty. Thanks for the kind words, as always. Well, very good. And so, yeah, that did take a good three and a half hours to cover the content. We just barely skimmed the news. And I have a big extra edition of charts that I've been wanting to have time to build out. It's very similar to Jeffrey Gundlach's Just Markets presentation he does once a quarter. It's a lot of slides, so we'll have to just kind of pick and choose the best slides to pull up. And I do hope to have that added into our daily presentation by next week. So I hope everybody enjoyed all the extra content today. And yeah, we're getting close. We're getting close. Let's just look at that H41 release just so we can get our chops wet here. I know we're all wanting this crash to begin already. So let me just show you what's been happening with the Fed's balance sheet so you guys can have a little confidence in what I'm telling you here. Okay, so if we go back 1, 2, 3, 4, 5, 6 weeks, we had $77 billion in QE. Then it jumped to $240 billion, wasn't enough. Then it jumped to $506 billion, wasn't enough. $605 billion, that was enough. Okay, so that's a huge, huge devaluation of the currency in the Fed's expansion of its balance sheet. But what happened after that? Did they just keep printing it? No, they've been dropping it by about a third. So we went from 600 billion to 393 billion to 228 billion. That was last week's print. So they are claiming they're going to do 25 billion a day in the treasuries. So that'll be in this area. So that could get us up to 125 billion this Friday. But then we also have to ask, what are they going to do with mortgage-backed securities? So it could be a little bit over 125. We can expect from the Treasury purchases. We'll see how much mortgage-backed securities they purchase. But I would expect this to be probably under 200,000, maybe closer to 150, 175,000, maybe less. And then you drop that again next week. And I think you're going to run out of liquidity quick. So, all right, wonderful. Really appreciate everybody's time. And we'll see you guys on Wednesday. Tomorrow, I'll update everybody with your positions. Make sure you know. Oh, yeah. What was your cost on that, Karen? Your average cost per put? See, you ended up getting in cheaper. I bet we're down a few pennies on the USO. Did you get close to $1 a put? Oh, so you got even more duration. Okay. Well, if we do get a pullback, you'll get even more profit on your puts. Oh, you went less duration for $1.09. Okay. Well, that'll do the trick, Karen. So I think you're gonna do just fine with that. Okay. Thanks, Tom. Really appreciate it. Thank you, everybody. All right, Ryan, let's go ahead and wrap this one up. We'll see everybody back on Wednesday. Appreciate it.